Hi guys, welcome back to the afternoon program for day one of Nordic Blockchain Conference 2026. Let's get cracking. For now, we're starting with trading trends in crypto, and I am so delighted to be welcoming Julian to be moderating, and then we have Stijn, Christopher, and Rebecca ready, and I hope that Christopher will be joining us. He's here, fantastic. Let's give them all a big round of applause. Let's get started.
Do you guys hear me? Fantastic. Yeah, hello everyone. Let's get the panelists here on stage. Trading trends in crypto. We talk today about retail and institutional dynamics. I'm Julian. I'm leading the Nordic and German market for Bitvavo. Bitvavo is one of the biggest exchanges in the world in terms of Euro spot volume. And with me today are Stijn, CEO of Crypto Finance, Chris, CEO and founder of Tradias, Krista, country lead of Sweden, right, from Coinmotion, and then last but not least, of course, Rebecca from Stack by Me. Yes, Rebecca, retail. Let's start first before we go more into the weeds here. In terms of institutional trading, talking about real-world assets, settlements, etc. Where do you see a gender gap maybe happening right now? If I look into the room, I see actually more males than females. But you're advocating for more females in the crypto space. So what is the take here?
Thank you. I definitely do. And I do think we will see more demand from females going forward as well. I mean, up until this point, it has mainly been male-driven, the crypto adoption, and it has been men who has been first movers in crypto investing. But I think as it's maturing more and becoming more and more mainstream, and also with regulations helping to kind of validate that this is a real deal, I think the adoption in both like genders, but also all age groups will increase going forward.
Yeah. Do you also see that, Chris, like on the institutional side, that you feel like more retail is coming in?
Yeah, definitely. I think especially in Europe, the market has been very retail-driven so far. The most successful setups that we've seen, even on the institutional side, have been B2B2C setups, so very much driven by, let's say, the end client base that are demanding crypto in their portfolios. We've seen some traditional players, actually, the very German word Sparkassenverbund, so basically the community banks in Germany doing some research on where they see the outflows going. And they noticed that almost 30% of their outflows are going to some sort of crypto exchanges or players that have an active crypto offering, right? Putting that together with actually a generational change that is happening, particularly in Germany, where we have a relatively old population, and over the next few years and decades, we're going to see basically a tremendous amount of wealth being transitioned from the older part of the population to a younger generation. I think a lot of the institutional players have realized that having some sort of crypto offering for the retail base is absolutely crucial. I think when we talk about the gender gap, actually, obviously that's something we're seeing on the traditional financial side as well. So there's some research in Germany that I think the participation in equity markets is 29%, which is still relatively low on a global scale of males in Germany versus only 17% on the female side. Obviously, there's a variety of drivers that are responsible for this, but I think crypto and easy access to any asset class really can hopefully drive reducing that gap and making sure that there's equal access to all sorts of financial assets with an efficient technology in the background.
Yeah, and then Chris, the Coinmotion, also caters to more than 150,000 retail customers across the Nordics. Regarding advocating for more female investors and also thinking about the narrative of more going into speculation, what's your take here?
We had a side event at Tech Arena early this year, and it was one of the side events that were fully booked, so that was good. And 30% of the audience were women. The agenda for the event was crypto and kava, so maybe they were there for the kava, but at least they were there, so that is good. And as I have a marketing background, it's important to do some research when entering a new market. And we discovered that many of the sites are quite dark or blue, and the tone of voice is quite technical and quite tough. So I think the industry have actually created this gap. I think we need to be more accessible for everyone, women, but also people that are not that into tech. So we have some things to learn from that actually. And I think that is the road to success together with education. We can see that 60% of the marketing surveys respondents said that they were unlikely to invest in crypto, and it's mainly due to lack of knowledge. And they also think that crypto is for crooks. And again, that is a education problem, not a crypto problem. So we will try to achieve that in Sweden at least.
Yeah. Where do you see this going, like when we project that into 2030? Also in terms of the retail perspective, we see institutional investors are thriving a lot. Do you see like retailers also picking up in some point, like we saw in 2020, 2021?
Yeah, hopefully, but I will talk a little bit more about later. But the industry has changed a little bit, and spot trading is not what it used to be. And the spot trading has changed, the market has changed, and the product has changed. But I think the ETPs is also doing a great job when it's quite easy to get into crypto, and that is a great way also for them to get into crypto and maybe take the next step and buy the crypto on chain through a broker or an exchange.
Yeah. And then the first time or like first step actually getting into crypto for some people is stablecoins, right? Like we had some couple of panels today already speaking of the importance of stablecoins, especially in Europe. After Amiga, we have seen that the Euro stablecoin market has popped up a lot. We have only I think 0.3%, what I understood from Mads Christensen from Danske Bank, Euro C share, even issued by Circle. How important are stablecoins nowadays, Stijn? And where do you see this development actually going in terms of a functioning trading infrastructure for banks and crypto exchanges?
Well, I mean, it's a bit twofold, right? The brokers that are deep in the crypto market, like Chris or myself, we use stablecoins for settlements on a Saturday, on a Sunday. It's T+0, so it's really the oil that keeps the machine going. Otherwise, trading would be very cumbersome, especially on the settlement side, right? Traditional finance players don't have that need yet, I would say. So what I'm lacking a bit currently is the sheer business case. From my perspective, to be very blunt here, I think it's a bit driven also by fear of missing out. A lot of banks are looking at stable coins because they could be disrupted on their payment networks, right? For some, this is really not good if they look at that, so they need to be part of it, so not miss the train. On the other hand, stable coins, of course, have their valid well, in Germany you say Daseinsberechtigung. I don't get the English word for that. I'm sorry.
Claim for representative.
Yeah, thank you. That sounds like a lawyer, by the way.
Please no.
And we'll get there, but it's a rail, right? It's a technology. It's an underlying technology for payments. Here in Europe, the pain to change the underlying, as I said, is if you want to do 24/7, you have to have another rail. Is that going to be a tokenized euro or tokenized US dollar? To be honest, I don't know. Could be. So we'll see. But I think we are still in the beginning. There is a lot of digging into, especially on the big players in a traditional financial market. At least they got the common understanding that JP Morgan is not going to settle on a Goldman Sachs coin, right? So at least now we have those consortia, which is very smart from my perspective. So we'll see where that goes, yeah?
Yeah. And let's speak about the Genius Act, Chris. Like, in the US, like those, the EMTs, so the electronic money tokens, are basically tied to stable coins explicitly on US treasuries, right? And which framework is actually generally better for issuers? And is Europe building, do you think, like a stablecoin market for looking into 2030, 2035? Or just a compliant one, institution that can finally touch these stablecoins?
Yeah, I think step one is always getting some sort of regulatory clarity, and I think that's what we have now in Europe. I think that that's what we are very close to having in the US, especially now if the Clarity Act also gets passed. Now, I do believe that as any regulation, probably a regulatory framework, especially for something new that is emerging, both are imperfect in their own ways, in my opinion, and have shortfalls. But that's not necessarily bad, because again, step one is having some sort of clarity. I think when you look at Europe in particular, and we can talk about the Genius Act in a second, one major problem that we're still seeing is obviously the fact that you can't basically earn yield or pay out yield on stablecoins directly obviously brings stablecoins at a massive disadvantage compared to cash, right? So we get approached a lot by stablecoin issuers, Euro stablecoin issuers that are still small in issue size, and say, hey, can you make markets, right, for a stablecoin? And we're happy to do so. And as Stijn said, from a settlement perspective, we'd be happy if everybody moves over to stablecoins, but we're not the one who can push that, because at the end of the day, if our clients don't want to trade the stablecoin, then we have no markets to make, right? And most of our clients are retail facing. They are making money on the deposits that our clients are placing with them, right? So they're asking, okay, what's our benefit of moving over to the stablecoin? Because it's ruining part of our business model. So for them to be incentivized to move over, I think there needs to be some way of yield generation, right? Or at least a commercial agreement that they participate on the yield that's being generated on the back end of it. And unless that is happening, I don't really see, especially in Europe, how any of those stablecoins can reach critical size with the crypto business that is around. Now, there are other use cases, right? When you talk about remittances, global payments, et cetera, and if banks are utilizing their existing network and their existing network of clients, that can be a very valid use case. But to really break through and be a dominant player on the stablecoin side, I think you need to be able to pass on yield. And unless that is happening, I think under the Genius Act, that is a bit easier. There's a bit more flexibility, right? And obviously, that was a big talking point, and the main reason why the bill was delayed for so long. But even there, I don't think that the framework is perfect, because really what you're doing is you're incentivizing a lot of people to go, let's say, around the rules a little bit, right? Without having exact clarity of what is allowed and what not. So I think there needs to be another reiteration, both in Europe and the US, when it comes to stable coins. Because if we want to treat it just as another form of cash, then I think you should be able to get yield on your deposits as well, right?
Right. And we actually have a local legend in terms of stablecoins, the Sky protocol. MakerDAO, founded 2014 in Denmark, also has a stablecoin called the Sky US dollar, making up 2.5% of the global stablecoin market, which is around 322 billion US dollars. And then moving from stablecoins now into the tokenization of real-world assets, which is also, of course, probably a big driver for retail investment. We have seen now a asset under management or total value locked, as you say in the crypto space, mostly of 30 billion now of tokenized real-world assets. Do you think also, Rebecca, that female investors are more attractive to these asset classes like tokenized commodities, securities, etc.? Or do they rather stick to crypto because they got used to it now and it's like, hey, what's actually the difference? Because it's basically, and speaking of German quotes here, it's just the same wine in new pipes, basically just like the same shit like always, right?
Yeah, I think it's a good point. I mean, I think when it comes down to it, it's actually a bit like we talked about here already, like how do we package it, how do we sell it, how do we explain it? Because it needs to be very clear what the value is for the end user. And also coming back to it, that we have like an investment gender gap already in like mutual funds. Already there we have friction. So when we're talking about this a bit more complex products for the regular person, we really need to understand like how can we explain this to them and how to make it accessible for it to be successful in the retail market, I would say. Yeah.
And Krista, where is the real-world asset tokenization actually disrupting the existing business models versus just digitizing the new ones, what I said before? And like, do you think TradFi wants more efficiency or retail new markets, seeing like both sides of the medal?
Yeah, we can see TradFi benefit from stablecoins. Of course, there's a lot of talks about stablecoins this morning, but I think we should also look back a little bit, because in the beginning, stablecoins were mostly for like having something to park your assets when you are backing out of Bitcoin. because all the exchanges didn't have support for fiat. And now we're trying to find use cases for stable coins. I think that is quite fun. But I think the next step is also looking into agentic commerce, where we have AI agents need to do transactions on chains. And I think that is also a good case for this. And sooner or later we will have humanoid robots going around and enjoy the time on the streets when there are only humans on the streets, because soon you have robots and they will do services for us, and they also need a chain to transact on. So I think that there are a lot of opportunities for this in the future. But when it comes to the real world assets, I think that is really beneficial for retail, and I think that is the disrupting thing for retail, because now you can invest in whatever you want 24/7. One example is Hyperliquid. I think on a weekend in March, there were $1.7 billion in trading volume on an oil perp on Hyperliquid. So this is really opening up everything for retail that was not accessible before. But again, we need to be accessible, and we also need to educate so people can see the benefits of investing in this type of assets.
Yeah, speaking of investing into all futures, like on the crypto side, also Larry Fink, CEO of BlackRock, also said like every bond, every asset, every commodity will be tokenized at some point. We have seen the first wave of crypto adoption in the institutional space with the Bitcoin ETFs actually popping in, or ETPs, respectively. Stijn, like from your perspective, we have seen right now that commodities are actually the biggest driver in tokenized real-world assets. Where do you see this space is going into, and which asset will predominantly be in the forefront?
I think mid to long term, all assets. That's my perspective. Right now, we see especially a focus on tokenized money market funds to basically bridge the gap on not having the yield on a tokenized stable coin, right? But it will take a while, and I'm not so sure whether the end investor will see the difference between a tokenized share and a non-tokenized share. I think it will be the tech layer in the back that brings more efficiency, that allows for 24/7 trading. But to be honest, we also could get a 24/7 trading live on the systems that we have today, right? It would not be an issue if banks operate 24/7. But still, there are some aspects that are beneficial on an efficiency basis, that cut out some layers of the traditional finance, how we do transactions today. So I think it will be beneficial. But it will take some time, and we will see some hybrid market infrastructure, so the old way and the new way, aside of each other. And then, of course, it will transform. I don't believe that it will be like a switch from today to tomorrow, everything will change, but it will be a gradual change, right? And I said the level of optimization, agents that pay each other, it's going to be some shared, and there will be a trust layer is needed, and from my perspective, blockchain as a technology solves that trust layer best. So the likelihood of seeing that is quite high. Are we there yet? No, we just started.
Okay. Do you feel like in the future that we don't have traditional exchanges anymore, or like crypto centralized exchanges, decentralized exchanges on the crypto side? Do you think at some point there will be just one exchange layer that is basically built on blockchain?
Well, that's hard to say. I mean, it depends also very much on legal frameworks, on regulatory frameworks, right? You got jurisdictions, the US, the EU. Will the EU allow trading on? I mean, you got politics beside it. From a tech layer, I absolutely would agree. And from an efficiency play, yes, I would agree. But it's not only about tech and what's possible, but how can I make it possible in a legal and regulated way? Otherwise, there will be no adoption. And this is basically what sets the boundaries from my perspective.
Yeah, very fair. You touched upon the settlement layer. Now we spoke about retail getting into the tokenization of real-world assets, stablecoins, etc. Now deep down the line, what retail basically doesn't see are settlements. Chris, you guys spoke about this a little bit, going to intraday trading. Is it actually efficient to do intraday trading compared to T+2 or 1?
Yeah, I assume you mean intraday settlement, right?
Intraday settlement.
One of my favorite topics, because I usually have a different opinion than most other people, I think, in the room. So for us as a market maker, actually moving to, let's say, instant settlement processes will be extremely inefficient from my point of view, and I can explain why. So obviously, as a market maker, depending on who your client base is, etc., you need to hold the assets basically on that specific venue to make markets. Or with a lot of our clients, of course, we have post-trade settlement agreements. Now, what does that actually mean? They can trade up to a certain amount. We net the settlement amounts. So let's stick with the example of Euro and Bitcoin, right? Let's say there's a net buying activity going on from all of the retail clients that our main client is facing of 10 million euro worth of Bitcoin, and then we settle T+1. Now, if both legs are on chain, meaning if you had a stable coin and you have BTC, that would reduce the time of the settlement process the next day significantly. And that's a very good thing, right? So I'm all for basically settling on chain and making sure that settlement can be basically processed within 10 minutes, 15 minutes, seconds, whatever it may be, right? Shortening the settlement cycles, however, meaning we would say, or we would agree to settle every 15 minutes, makes that process actually extremely inefficient, because that would actually mean that the funds would need to be in place at all times to settle, right? Meaning that basically we couldn't take advantage of greater trading volumes with our working capital. We would have to have significantly more working capital to be able to settle at all point in time with all of our different clients in the network. You would have higher settlement costs, both on-chain and off-chain, because it's a huge operational burden on your team, right, if you need to settle constantly. And also, of course, you have the on-chain cost of settling, right? That's why I don't believe we're going to see, especially on the institutional side, the market moving towards instant settlement. I do believe that once you agree on certain settlement cycles, and then you decide to settle T+1, or maybe 5 minutes after the settlement cycle is completed, that is a great thing, right? But I think there's a bit of a misconception. We've seen some of the also exchanges for tokenized assets that say, okay, with us you have instant settlement. They ask us to participate as a market maker. But basically that would mean we would have to fund both sides for the bid and the offer, right? Both on the asset side and the cash side at all times. And that's extremely cash inefficient. It will result to higher trading costs, right? Because we have the cost of funding in the background. So from a trading perspective, I believe let's keep the settlement cycles, maybe shorten them slightly, work with netting procedures, and then make sure that the settlement process can be completed as fast and efficient as possible.
Fantastic. So this is basically what we wanted to talk about today. We had a world-class panel. One last world-class question to you guys in terms of the World Cup. I'm sorry for any Dane that is here in the room. Rebecca, who do you think wins the World Cup?
Well, I'm a forever optimist, so I'm going to say Sweden.
Good, this kind of stuff, yeah.
Honestly, I have no clue, but I think Rory McIlroy will win the Open.
So I have a Canadian and a German passport, so I'm hoping for a Canada-Germany final, but the chances are slim. Huh?
Here I have to pass, I have no clue.
I'm not voting for Germany, unfortunately. I think France is going to make it, not only because of the very clean and slim representation of their fashion style when they walk into hotels. If you guys know what I'm talking about. Thank you very much, guys. That was very exciting. And yeah, I wish you a very good day. Enjoy the sun and see you around. Thank you. Bye-bye.
I was going to say we have time left if anyone has any questions to what was said. We have time. We have time. Let's see. Let me just check the program. I mean, we have a good 10 minutes. If you want to go deeper, if there's any questions, you're all good.
Yeah, fantastic.
Perfect.
There's a question over there. So the question was if we would have any take on Shiba Inu's development in Spanish taxis and the correlation to the global crypto market.
Well, it's just an example.
So basically, you mean that taxi drivers have like started trading? Okay, yeah. Or like on the taxis themselves.
Yes, you can pay with.
Interesting.
Yeah. So, what do you think about this? Meme coins and the progress, because it's not stable coins, right? So it has more progress than.
You want to? Yeah. Here you go.
Yeah, so I think so. I didn't actually know the specific example about the taxis in Spain. That's very interesting. But I think in general, when we think about meme coins, we do offer whatever our clients want to trade. So we offer 120 coins that we price for. For us, it's always more a question of liquidity and can we get access. However, when I look at the long term, I would be cautious when it comes to some of the meme coins. And the reason is I do believe the coins and the projects that will survive in the long term are the ones that create value in the real economy, right? Whether that's because they're a base layer for tokenization, whether that's because they're used as means of payment, right? So if Shiba Inu actually manages to become a major method of payment, then that's great. And then there's your use case, right? But that's the main question I would always urge anybody to ask themselves, what am I buying here? Is there a use case that this project is fulfilling, right? What are they actually working on? Or, of course, treat it more like, let's say, an NFT, right? If there's a specific value attached to it, that might be another use case that I'm a bit skeptical about, but there might be reason to believe why that is fine. I do think that a lot of the projects in terms of the meme coins that we're seeing will not necessarily survive in the long term, or at least have those financial returns that you would like to see. We're also seeing on the institutional side when it comes to the trading pattern and behavior that, of course, especially for some of the smaller, more liquid coins, there's a lot of, let's say, gray area market behavior and trading behavior that happens from a lot of insiders that hold a large amount of these coins. So I would always recommend to be careful and inform yourself before making any decision when it comes to meme coins.
Great. Thank you. I advocate on that. Yes, please.
A question also for Christopher. I had a follow-up to the instant settlement topic. Normally what we see quite a bit in the institutional space is that the ones who ask for it are the ones who have decided to insource this custody infrastructure. So it very much becomes a topic of, I want to minimize my counterparty risk to the liquidity provider by returning the crypto assets to me as early as possible. What are generally the argumentation? And obviously, I'm a representative of crypto finance for transparency, hence the question to Christopher, not to Stijn. What is normally the narrative that you push against?
Yeah, for sure. I mean, I think that's a valid point. If you want to remove all risk, right, then of course instant settlement will help you do a large portion of that. What I would push against is that comes with a price, right? So usually in traditional financial markets, you would work with prime brokers that extend leverage, and that would maybe allow players to settle faster or trade a larger amount than they would be able to do with their own capital. Now in crypto or digital assets, I don't think we are at that level of maturity yet, mainly because there's not enough players with large amount of balance sheet that can extend leverage. So leverage is extremely expensive to come by. So it's a trade-off between removing risk versus price, right? And I think that's where you have to make a decision is, let's say, an extra 8 hours of, let's say, settlement risk, right? And that's where you take maybe the counterparty risk, or at least the pricing risk that you would have to cover the assets somewhere else if your counterparty can't settle at a different price. Is that worth X amount of basis points, right? And I think that's then where you need to have that discussion. And I think most clients, at least from our interaction, because we've had those requests as well, right, will arrive at the conclusion that removing risk at all costs is maybe not necessarily what they want to push for. But I do agree, right? If you're very conservative, and then let's say, especially if you're moving into a new asset class like crypto, that can be a valid approach. And it's not that we haven't done that before with clients. I just don't think it's the most efficient way of interacting. And again, we don't see that in traditional financial markets as well. No.
Do we have any? Yes, please, in the back.
So basically, from a retail on the crypto native platforms, obviously we have that, right? From an institutional perspective, we see it only on the Kraken platforms. I mean, Coinbase is looking into that.
We're also looking into.
You're also looking into that, sorry, of course. But for me, the question is not so much, does it need to be tokenized on Kraken or Bitvavo? I mean, they just want to be the platform where you can also buy securities, right? To expand their investment portfolio that they offer to end clients. So whether it's tokenized or not is a different question. But there we see it, right? Although it's not necessary, actually, from a technology point of view. But it's limited. I would say what we come across, it's quite limited. Obviously, over the last 10 years, we have done a lot in tokenization, from art, wine, structured products in the investment banking, bonds, shares. But did it take off from an industrial point of view, where a bank decided, that's it, I'm going to switch my operating model to Ethereum, and I will only launch structured products on Ethereum? That hasn't happened yet. I can tell you the cost savings were immense, but at the end of the day, it's still very risk averse, right? So they set it up as a proof of concept, maybe as a hybrid infrastructure, but the appetite to go all in is very low.
Yeah. Any other questions? We have 5 minutes left. Yes, please.
Good afternoon, everyone. Are you seeing any appetite around prediction markets? It's a bit of a hot topic at the moment. There's some royalties on. Interested to see your take on that direction of travel and how you're sort of approaching that potential opportunity.
It's an interesting one, especially for a Dutch exchange where Polymarket was actually banned now, or like not allowed to operate. Just like from this perspective, but I think it depends on jurisdiction. But I'll leave the stage to you, Chris.
Yeah, we were actually talking just before we went on stage about this and sort of our takes. So we've been looking into this for the past weeks, but more out of, let's say, curiosity. I think it ties back to Stein's point from earlier. I think the pace at which the crypto markets or digital asset markets are evolving is accelerating, which means that I think for any player, whether you're a retail-facing platform or market maker, you need to be able to basically service multiple different asset classes, right, that are settled on chain quite dynamically. And I think that prediction markets could very well be part of that in the future. But I think there's a few hurdles. And number one, of course, as always, regulatory issues, right? Particularly in Europe when you look at it. So, of course, you have Kalshi in the US, which is regulated as a basically contractual market. Here, most of the events that Kalshi is putting up on their platform would be regulated under the gambling license, right? And there's a big distinction because at least in Germany, gambling is limited to 1,000 euros per bet, right? So from an institutional perspective, that of course significantly limits, let's say, the market size and trading activity you could see there. And then I think the second issue is, so Kalshi, for instance, makes 90% of their trading volume with sports, followed by politics. So sports is gambling in Europe. Politics is not allowed, at least in Germany, to bet on political outcomes. So 95% of the potential is not even really accessible, right? That's number two. And then I think number three becomes, and we've also seen this a lot with prediction markets, and now I'm talking from a more of a market maker perspective, when you make markets for uncertain outcomes, sports, weather, anything like that, that can't really be influenced by one single person or outcome. That is a fair market you can make markets on. When it comes to questions like, is country X, like the US, going to start a war within the next 14 days? There's a massive amount of insider trading and asymmetric information that's going around, where it's extremely difficult and challenging for a market maker to make markets on both sides and not at the end of the day be holding the bag and lose money. And then lastly, and that's the last point I would make here, is obviously you've seen some of the outcomes of those prediction markets where it was unclear who won the market. I mean, in Paris, you had a guy with a fan, right, basically manipulating the weather because he bet that there's going to be record temperature in April in Paris. And he won a nice bet. You had death threats against a New York Times reporter because he was reporting that debris of a rocket fell on Tel Aviv, and then people were urging him to change the story that a rocket actually hit Tel Aviv because the bet was that a rocket would hit Israel. So I think when you see these stories from a reputational perspective in the institutional space, you need to be extremely, extremely careful. On the other hand, I think when you talk about economic outcomes, are interest rates going to go up or down? What is the Fed going to decide within the next 30 days? Prediction markets can be the purest and most direct way of expressing your view and your opinion, right? So I think there is a use case that maybe fits more within, let's say, the maturity and seriousness of a traditional financial market.
Yeah, thank you very much. But one bet is clear that the tokenization of real-world assets will still accelerate a lot. And once again, thanks very much. Now we got it. And have a good day, guys. Yeah, thank you again.
Thank you so much, guys. So it's my pleasure to introduce Omri Ross, who is Chief Blockchain Officer at eToro. He will go into all things DeFi lending and bring a fresh perspective on that. So give it up for Omri.
Okay, thank you very much. In a second, we'll start. I have maybe a little bit of a fortune role that I both in charge of a lot of the crypto operation at eToro, and at the same time have some experience working with academia. And I guess this presentation will somehow include a bit of both. We'll mention a bit about eToro. We'll mention a little bit about some of the classic sort of trades we see around the DeFi market for lending in quite high details. And then we'll look a bit into products related to that. Feel free to interrupt me throughout. You don't have to wait for the end if you have any comments or so. Yes. So, great. Normal disclaimer, this is not an investment advice. It's not close to investment advice. Do everything at your own risk. Great. So a little bit about eToro. I assume many of you are aware of us, but our vision is really to open a global market for everybody to trade in a clear and transparent manner. There are a lot of free information as well as information about learning around trading. We'll discuss a bit more about it later. And we try to be there everywhere. And currently we have north to 4 million accounts which are funded by our customers and close to $19 billion. This information is from the end of March. Previous financial reports. And most of our customer base is actually in Europe. We have around 70% European and around 10 to 15 between the US and Asia Pacifics, which are our largest markets. We try to be a one-stop shop for retail investors. And what it means for us, it means that we have a lot to cover within investment, 20 plus global exchanges. We support a lot of crypto. I will discuss it in a second a bit more further. As a one-stop shop, we want to allow you to have your card, your Visa cards. We even have different cashback sort of elements around the Visa card that you can look into that. I'm not sure if it's available in Stockholm. And we have our copy portfolio, which is something we initiated where people can follow different investors. We actually spend a lot of time with these investors to also allow them to tell you more about what they're doing. You can follow many seminars. You could follow many strategies. Actually, it's very fascinating. And for us, everything we do is always trusted and regulated. So we work with regulators, and the business is regulated in every country. And specific within crypto, we have 200 plus coins that you can buy, sell. We offer staking on a large amount of these different coins and tokens. We have the eToro wallet, in-app wallet, and we recently acquired Zengo, which is a DeFi wallet. And we operate along a lot of different verticals in there. If you're more interested in that, come and talk to me or come to Dove. We have a single stand here outside, so you're welcome to discuss it more with us. Also, if you have feedback about what doesn't work, please do. We're very curious to learn how to improve our service and Yeah, everything you feel, share with us. But more specifically today, we're going to discuss a little bit about DeFi lending. So maybe the first thing is let's discuss how DeFi lending actually works in a very simplified manner. So of course, if you want to get a return on your asset that you hold, whether it is ETH or USDC or anything else, you can always add it to a pool and start earning some interest from it. If you want to use it for lending purposes, you can, of course, become a lender, as mentioned here, based on the asset that you put in this pool. So if in this example you may have whatever $1,000 of Ether that you put into a pool, you can decide, for example, to borrow 500 in worth of USDC. In this case, obviously, you are, which is not always the case, but you borrow a different currency than the currency that you're actually using as a collateral. So that's often, at least in the most basic element, can either serve you as a way to sort of deploy your asset to receive some interest, and being able to get some loans based on these assets, because often some of the challenges with crypto assets is that it's hard to get sort of to be able to use them. And as you can see in this case here, obviously, if the value of your holding of the Ether is holding, you may be liquidated, right? As it would be the case with any asset that you hold. Usually, the liquidation threshold is anything from 80 to 95%. So you may need, in this case, if you're still borrowing $500, if your ETH worth is somehow not fairly close to that in value, you will be automatically liquidated. Nowadays, most of it are done by MEV arbitrage bots. So actually, you can usually within a block already liquidate a position around that. So what people actually use it for? So I think the first case we want to talk here is something that is sometimes called looping or recursive lending, and is a way for some investor to receive a more sort of directional exposure for a token with some leverage. If we take the example here, we see on the left side that the investor might have taken $100 worth of ETH. On this account, they borrow 80 actually US dollar, maybe USDC or any stable coin representing that. Then they can convert these US dollars elsewhere, say in Uniswap or wherever they choose to ETH again, and then they can borrow based on this element again. And this sort of recursive way of sort of borrowing is what we will refer to as a sort of a more directional trading, because eventually you increase your exposure to the risky asset. In this case, it will be Ether, and you somehow borrow a little bit more in USD, and you do it recursively. Actually, you don't have to do it one after the others, because using something like flash loans, or that maybe many of you are familiar with, you can just borrow within the pool the assets. So you can just sort of in the same transaction that you actually introduce your loan, you can directly do this looping process and get the exposure. Yeah. What we will refer to as a carry trade is a variation of that, but I'll take a few seconds to discuss the difference in this variation. By the way, everybody hear me well in the end or in the back? Perfect. So in this case, you can see that as also it's maybe somehow seen within the slide, there is quite high leverage in the sense that you move from one holding, in this case of staked ETH, to borrowing maybe 19 times this amount in wrapped ETH. So let's talk about it a little bit. So one of the reasons why this phenomena is possible is because they are both will be seen by, in this case, say Aave or ETHLend, as correlated tokens, because they are both exposed to ETH only. If we take the previous example here, you borrow $1 to invest in ETH, so somehow you're exposed to much more risk from the different trading within what you own and what you have. And maybe a lot of people see them as highly correlated. We also know we had some recent event within Restakes ETH, but we'll talk about it a little bit more later. But what you see here is that they have this sort of emo mode that some of this protocol offer you, where you can get quite high leverage specifically around correlated tokens. Similarly, the same exists actually with stablecoin. Just to save you time, I won't show it here. We have slides and information of it if you want to see it later. But actually, around 95% of all borrowing that happened in these markets is somehow divided mostly between the carry trade between correlated tokens, which means that one, and that one, the directional trading between people want to have most exposed directional, which offer you about 40% additional. And want to talk a little bit about how these two coexist and how the market sort of capture this. So we looked a little bit into some aggregation of depth. And the way we looked into, I mean, we looked really in all data of any trading or any assets that ever existed on Aave over the last 4 or 5 years. And you can see that we can really sort of classify them to depth and to somehow equity, what you hold. And what you can see between the two graphs is you can see that maybe the yellow part or the green part are somehow disproportional down here. So the green part, we'll ignore it because it's mostly around Bitcoin lending. But the yellow one is interesting because it looks a little bit more into sort of stablecoin trading, and you can see that the amount of equity is quite low in comparison to the total amount. So what we do see that the actual trade that people do around this market is very specific trade, and I will take a few seconds to explain it. So you can see here on the borrowing side, the red sort of color representing depth and represent what people actually try to borrow on Aave. And you see that it almost exclusively ETH. And what they do with this ETH, they restake it, either directly by one of the protocols that offer you restaking it most of the time, and then sort of get more depth in it. So for example, you take some, you bring some restaked ETH, you put it as a collateral, you borrow some ETH, and then you convert it to restaked ETH, and you put it back in, and you borrow some ETH recursively. So of course, a lot of this is depending on how much ETH is actually available for you or wrapped ETH in Aave. There is also a sub-variation of it in restake ETH. It's quite smaller in size, but it's similar methods. I will skip it here quickly. But what we saw is that actually that out of 70% of this sort of depth, that is kind of at the most 70% of the depth was actually captured within these strategies, which we call them sort of the correlated token strategies, either that you are long-time stablecoins or Ethereum. They only have 15% of the depth in terms of the equity that they hold for it. So they're all quite highly leveraged strategies. This kind of graph actually tried to show a little bit how much leverage exists in the different strategies based on the different sort of trader type. So as you may see here, we sort of categorize them to carry trades. The carry trades are what we call them when you borrow it and you kind of invest in it. And the directional, because that actually means you want to have more exposure to Ether, you just want to have a little bit leverage in there. And we can really see here that the more directional one are really kept around the low leverage element, anything between 1 to 3. When you actually move with the sum of the carry trade, you can reach even sometimes close to 20 at the top for Ethereum. But funnily enough, even though this sounds very sort of risky to capture with, you can actually, I'll move a little bit faster, but you can actually see that there was actually rarely liquidation of any of the leverage trading of the ETH or the stablecoin. I'll go again pretty quickly with them, but in the similar sort of format, here the more green and red one discuss the more directional trading. So it means the trading where you're not sort of exposed to the same token. And you see that almost all of them has been in these ones, very rarely in the other ones. And actually, you can see in the end here that in May, after what we had with the restaked ETH, we actually did not have any liquidation. It even looks smaller than usual. So let's talk a little bit about some of the challenges with it. And maybe if many of you are familiar with the concept of rehypothecation, which means you borrow sort of recursively on the same assets. So the first step when people usually do it is there is some assets that are supplied as loan in say Aave. User can somehow borrow them and pledge something, so they put a new collateral around it, and then users sort of repeat it recursively. And the reason I'm repeating it again is because one of the funny things that have not been a problem in this case, but it may be something people will be at least considering about, is that when you unwind it, it's the opposite logic. So obviously, if your assets are highly leveraged, to unwind it will require that there will be a lot of liquidity to sort of unwind the position. So of course, there is pros to it. You receive interest recursively, but there is cons to it, where liquidation can be limited. And maybe I'll do a bit quickly and just focus a little bit on the liquidation here. It's a little bit hard to see, but a lot of one of the main issues for lending market has been that it's really hard to find someone want to lend for the exact same time as you lending. So most lending market are actually perpetuals. You put money for a loan, and you expect to be liquidity so you can close it at any times. But what you can see here is that the protocols usually try to keep it around 90%, 80 to 90% of the pool loan, so you receive some returns for it, but still 10, 20% of liquidity. And around the issue with the risk-takes it, you've seen an increase all the way to 100%. So it means there was very hard to sell your assets because there were no liquidity in many of these markets. This issue was handled by somehow affection of the interest rate. I think I don't have so much time to explain the whole process, but if you want, come and chat with me afterwards. But you can see that the spiking on the interest rate below was one of the reasons and one of the ways that this protocol tried to kind of work and getting you a little bit more liquidity. But I think I'll skip it for now because of some time constraint. And maybe run a little bit forward to... we did see that after these elements, there was not a lot of fall in the amount of assets that were invested around Ethereum and the staked element afterwards. But we've seen that a lot of the stable coins liquidity has been reduced, and especially because the interest rate has spiked to 7 to 15%, and people did not make sense to do the recursive trading there. In terms of real-world application for retails, we can do a lot of things. Obviously, we are not necessarily doing or not doing any of this stuff. As a public company, we usually are not allowed to discuss most of these things. But you can really create mechanism to open loan, to change the loan directly for retail in a very simplified manner. Because a lot of what you've seen before requires quite high level of technicality. And in these cases, you can automatically deleverage customers. You can offer them different loans. And you can allow them to actually receive capital based on their long-term holding of assets to be able to invest in other matters. Yeah. So thank you very much. And if you have any questions, let me know.
Lovely, Omri. Thank you so much. Let's see. So next up, we're shifting gears as well, going into ETFs, ETPs, and crypto derivatives. Because I don't know about you guys, but in the Nordics at least, not only did Danske Bank in joining the Kivalis consortium back in September, that was such a pivotal moment for predominantly institutional adoption here in the Nordics. And another milestone was back in December when another one of our major banks, Nordea, announced that Nordea customers would now be able to have crypto ETFs in as part of their accounts. So going into to the new wave of crypto investment products, I'm very delighted to welcome on stage. We have Christopher from Virtune, Damien from Kaiko, Frank from Safello, and Jacob from Valour.
Test. Doesn't work.
Test 1, 2, 3.
Panel is the best. Test. Okay. Bonjour à tous. Hi everyone. My name is Damien Schuler. I run sales at Kaiko, which is a data solution provider specialized in digital assets. So we do market data, we do analytics, rates, indices, benchmarks, and on-chain delivery solutions. A lot of the product will be mentioned during this panel. This is called the new wave of crypto investment product. I believe the new wave is less new than it is actually maturing, and maturing pretty fast. Last year, the European market of ETP peaked around $19 billion at its peak in October. So it's really maturing, even though I believe it's landing around, I don't know, something like $14 billion nowadays. But correct me if I'm wrong, obviously. I'd like to cover 4 main topics during that panel. One is the market trend. 2 is the institutional adoption. 3, what regulation looks like now. And 4 is what's next. So I have 3 key players of this ecosystem on stage today. Okay, Jacob Lindberg. Yeah, of course. Jacob is the Chief Revenue Officer at Valour, which is the ETP arm of DeFi Technologies. Also the Europe's most prolific ETP provider by the number of products, something around 90 product, I guess. And for those who are not aware, Jacob was also the founder of one of the co-founder of Vander, a European-based ETP index provider for ETP issuers, acquired 2 years ago by Kaiko. So Jacob knows the ecosystem by basically every angle. Frank Schuil. Frank co-founded Safello in 2013, which is the leading crypto exchange in the Nordic, which is also, stepped back and then came back this year as a CEO with a clear agenda in mind, which is to focus on institutional. And last but definitely not least, Christopher Kock. Christopher co-founded Virtune 3 years ago this month. Now more than $300 million in AUM, 160 plus K investors, 23 ETP-ish. First profitable year last year with more than 90% of ETP Europe volume, trading volume on Nasdaq Nordic. Gentlemen, welcome. Let's start with the first topic, which is the state of the market. And so just mentioned from its peak at $19 billion last year, now dropped by something like 40%. I'll have the first question maybe for Frank, actually. So you
won that one.
You return as a CEO in the middle of this drop. Do you see this drop more as a temporary correction, or do you see it more like as a reset of how European investors actually invest? So curious to see what do you see in terms of market trend, and if you can walk us through the logic of your new approach at Safello.
Well, there's a lot of questions in one. Well, the market as such, I think, goes in waves. I'm pretty used to it after 13 years in the crypto market, so I don't spend too much time thinking about it. But if we look at the regulatory environment, there's maturity. If we're looking at the products in the market are maturing. So when I started, it was just a pipe dream that crypto would make it. Now everything is just part of the traditional financial market, you could argue. So for me, it follows by and large the overall trend. And then there's some geopolitics flavor put to crypto, whether it's as a real asymmetric or like a hedge against the regular economy. I think by and large, that's not the case anymore with crypto assets. So I don't have a very strong opinion about the overall market sentiment. So for someone like myself, who's been, I guess, as long in crypto as I have, I look for the new opportunities and what's interesting within what is, kind of an established asset class by now. So I don't know if it's going up or down in the sort of the overall market. I would say that follows the macroeconomic picture by and large. And for Safello, it's the age of or the time for commercialization of the license that we got. We're the only one in Sweden who had the marketed crypto asset license. So that is on the retail platform, but also moving into the institutional market. Whereas on the one end, we're working on a direct kind of crypto offering with institutions, which, we may or may not be able to announce something for hopefully this year. And then, direct access for institutions, we decided to join, these guys into having a structured product to the market with the ETP, the Bitensor Stake DAO ETP that we launched. So, that's the short of it.
Thank you, Frank. We'll come back to the institutional adoption right after, indeed. Maybe, Frank, from Christopher, sorry, from Virtune standpoint, what do you see like in terms of inflow since last year? Those like your clients like reduce the exposure, maintain or increase? What basically like the inflow tells you, and what you can share with us?
Yes, absolutely. So obviously the market has been volatile since the 10th of October. But since then, we as a company, we're focused on the long term and driving crypto adoption forward, mainly through education and other distribution-related initiatives. But if we're looking at our flows, for example, last year, we had around a little bit more than $200 million in net inflows. And year to date, we have around $35 million. So what we are seeing is that many investors are taking the volatility we're seeing in the market as an opportunity to accumulate for the long term. So that clearly shows that also looking at crypto as an investment to allocate into one's portfolio, that is something that has matured quite a lot. And that is, of course, driven also by the fact that we are seeing increased institutional participation, but also more professional allocation from, for example, financial advisors across Europe, but also here in our home market, Sweden. Okay, excellent. And Jacob, finally. So Valour, which has a very broad range of ETP product. You've done like a profitable Q1 this year, despite the drop in terms of AUM. What can you tell us about the market trend in complement to what we just hear?
Yeah, our AUM is $500+ million, which is by far the largest on this panel, and we've also seen net inflows this year. So even though other players in the market may be contracting, we are big and growing. And I think that that's a strength. We earn primarily fees on AUM, but also trading fees. So if it were the case that prices dropped a lot, so long as people trading these ETPs, then it is possible for our company, the parent DeFi Technologies listed on NASDAQ, to be profitable. The Q2 report came out, resulting in a positive reaction from the market, and we're a very stable firm, $100+ million cash on balance sheet, and I think when it comes to the adoption, the first few years was a retail wave. I remember, I think it was 2013, 2014, your first marketing video was a cowboy saying that it's the Safello, and I just thought, what is this? So clearly targeted towards retail, and now you're back in the.
There's an anecdote. Well, there's an anecdote there because it worked the best with the Barclays bankers in London when we were into Techstars. They loved that video.
Of course. And so and now you're focused on institutions, and so am I. I'm with Valour to focus on institutional investors after years of retail adoption, mainly driven by things like ease of access, no risk of losing your own crypto if you lose your password or your passphrase, as well as tax incentives. So I think this is a great time to invest in crypto, whether it's Bitcoin, ETH, or any other crypto assets. We have, as you said, the broadest selection of crypto assets. So if you're already invested in Bitcoin or ETH or the basic ones, then feel free to look up the different exchange-traded products that we have. And we have 100% of the trading volume on Spotlight.
Thank you, Jacob. So that's interesting to see that we have three players, major players, basically targeting somehow similar like prospects, clients, but they have different positioning and strategies, and it would be interesting to deep dive a little bit on exactly what differentiates them from each other and which path they've chosen. So maybe we can discuss about institutional adoption and the path you've taken. So the market is clearly consolidating now, and a few figures maybe I've noted, like it's 74% of family offices globally are now exploring or invested in crypto. That's clearly a number that it was not even possible like a few years ago. But the difference between exploring, like having like a family office exploring the crypto and having like a proper pension fund allocating resources into crypto, that's slightly different. So looking to understand where we really are in terms of institutional adoption, maybe you can keep the mic, Jacob. So what do you see among like your clients in terms of appetite for the crypto market in general, but also beyond like the main crypto assets, which are Bitcoin and Ethereum?
Family offices are definitely the first ones to allocate to crypto. They have a shorter decision time than a pension fund. They have less capital. They have more flexible mandates, often one person or a few persons making the investment decisions. And so that's naturally a first step, whereas the pension fund is the last step. Although pension funds are indirectly allocated to crypto, in fact leveraged Bitcoin through strategy. So they have some of Michael Saylor's stock. And I think how these people think is very different from how retail thinks. It's not so much about price, and it's much more about how does this fit into my portfolio. So the argument I always put forth is, if you look historically, if you allocate 1%, 2%, 4%, 8% of your portfolio to crypto, for example, Bitcoin or a top 10 index, then this is what happens to your risk. This is what happens to your Sharpe ratio, Sortino ratio, which is like Sharpe, but with only looking at the downside vol instead of the entire volatility. Drawdowns, and then you see empirically it makes a lot of sense to put a little bit of Bitcoin or a little bit of crypto index into your portfolio. But that's for the past. So then you need to look into the future. Why should you allocate into the future? And then we end up in a discussion on macroeconomics, liquidity, dollar supply, what will happen to the US dollar since the crypto market is priced in USD. And so these people have different frameworks for investing than retail, which can be driven a lot by fear of missing out, price jumping, and then people aping in, which is the technical term of fear of missing out in the crypto industry. So we see trading volume spikes as price goes up. So there are different dynamics there, and I think the AUM is much more sticky for institutional investors. Retail investors may take profit much earlier, whereas institutions, once they set their allocation or their allocation framework, for example, we're going to set a 5% allocation to BTC and then hold that with quarterly rebalancings, then this policy is much stickier than 100 or 1,000 retail traders buying, let's say, the Bitcoin Zero ETP on Avanza or Nordnet. So I think the flows are stickier, the framework with which they evaluate the assets are different and more rigorous, and that's where things like portfolio theory comes into play as a great argument.
Thank you, great insights. Maybe Frank, indeed. So yeah, you decided to come back to Safello in the context of the correction we've mentioned, so as you pivot into institution, I'm curious to understand what typically Safello will be able to offer to banks or to Swedish asset managers that typically someone else is not able to provide.
Well, the market in general in Sweden has been somewhat dominated by the ETPs because of the ISK structure, which is not everybody familiar with. But basically, when you put it in the ISK, you have a much more favorable tax rate than if you buy crypto directly. So one of the reasons why we're tipping our toes, we're definitely not the largest AUM on the ETP side, but we're tipping our toes in this specific sort of niche ETP is because it makes it easily accessible, in a structured way where most of retail likes already buying and selling. So yeah, we're on Nasdaq with ETP, with the different brokerages, but we're also able to launch it on SIX. Soon we're going to be on Euronext. So it's a kind of a different thing. But on the other side, there is still demand for real crypto, even with the institutions. And the argument that we see with institutions that we are talking to is primarily as kind of the escape valve, the hedge against sort of the global economy. So the need there is that you do have real crypto sitting that you could, take out, and even that it is a mechanism by which you can take your portfolio, liquidate it, and have an escape valve. And that comes obviously because of the geopolitical tension, specifically in Europe. But it's becoming a real argument where, from the institutions that we're talking to, that there's real demand for that. So that turns into you must have it, and obviously we are sitting at the intersection with the only company here in Sweden that has kind of the historical track record of dealing with real crypto assets within a regulated environment, and now we're in a licensed environment. So we're working on something. Not necessarily we want to talk about today, but we see real demand, and we think the time is there as well where the demand is going to go from a theoretical one, which has been for many, many years, to, okay, let's do something. And the risk, so we had an LOI a long time ago with Avanza, for instance, in 2022, but that couldn't materialize because the regulated environment wasn't there. There was no MiCA, marketing crypto assets regime. And now that it's there, you do see an attitude shifts amongst both the family office, the asset managers, as well as the large banks. That's kind of what we're seeing in the market, and there's a change of attitude.
Thank you, Frank. I wish we have the same type of incentive in France, but unfortunately we don't. Chris, so Virtune has more than 160K investors, but it's primarily focusing on retail and wealth channel through some Avanza, Nordnet. But how do you see that institutional layer coming in there, using like the same framework? Is it like compatible, and what do you see in terms of adoption within that overall framework?
Well, I would say that if you look at the broader crypto markets when it comes to institutional adoption, and you, for example, compare Germany to the Nordics, or you compare it with the US, Sweden has to some extent been behind when it comes to institutional adoption. And we have, since we listed our first product in May 2023, been actively engaging and communicating with all sorts of institutional investors, both family offices as well as wealth management platforms, among others. But I certainly would say that one very important threshold that many institutions need to come over here in the Nordics, that we certainly see is happening now, but that is a knowledge transfer that needs to happen to understand Bitcoin as an asset class when it comes to its properties with a limited supply, a predetermined supply rate, and so on, so that people can actually start seeing it as a store of value. So that is obviously something we have been focusing a lot on in educating the market on Bitcoin's properties, but also when it comes to that Bitcoin has a low correlation with other asset classes, and the fact that having, for example, 5% Bitcoin in a classic 60-40 portfolio will actually improve your risk-adjusted return. So that is certainly one part. The other part that we are seeing that is a quite interesting transition, but that is the two big trends in the crypto market that I think everyone here is obviously aware of, but that is the growth of the stablecoin economy that is now around $320 billion. We have the tokenized segment of the market of real-world assets that is currently around $30 billion. And what we are seeing, and sometimes when we are talking to institutions, is that some traditional portfolio managers, for example, they can have an easier time understanding an investment in, for example, Ethereum as the infrastructure and rails for the growth of the stablecoin economy as well as tokenization. So I would say that these two areas have certainly helped to accelerate the institutional interest here in Sweden. And with that said, we are quite confident that And that is also reception we are getting from the market, but that more and more institutional investors will seek to have diversified exposure to the crypto market. So you basically want Bitcoin as a store of value, but you also don't want to miss out on having exposure to the growth of the tokenization market as well as the stablecoin economy. So that is why we have also focused quite a lot on the stablecoin, on the index segment side, where we, for example, have launched a product in collaboration with Coinbase, which serves to be the crypto market's equivalent to the S&P 500, where you can buy the whole market in one product.
Interesting. Yeah, Jacob, you want to add something maybe?
Yeah, just to echo on ETH. If you look at the Bitcoin ETF and the Ether ETF in the US, the Bitcoin ETF has $100 billion in AUM, and the ETH has $28 billion in AUM. So the ratio there is roughly 3.5x. But if you look at the market cap of Bitcoin to ETH, is more than 5x. So Wall Street prefers ETH more than the general market does, or at least allocates more to ETH than the general market does. And I think that says something. That thesis is easier to swallow. ETH is a world computer where you can run smart contracts, and it's the operating system for smart contracts. And this, I think, is an easier sell. It's less of a criticism to the existing system than Bitcoin is, especially if you read some of the text on the first few blocks that were mined. And so I definitely just want to bring that point up. And then on the indexing side, I agree as well. So it's easier often for me to make the case for index investing and say that you want to own this market. This is new technology. It's different from other technology. Here with an ICO, it's almost like taking a company and doing an IPO first and building the product later. And it's many things are different. The level of decentralization is different. You need to think about tokenization, whereas for a fintech, stocks give you a certain legal right, and now you need to evaluate the token. Does that give you right to profits, right to revenues, etc.? And it's not always clear that revenue is the goal of these tokens. So I think that an index play is an easier sell, and also with my history, it's kind of easy to argue for indexing, since I founded Winter in 2019 and ran that as a CEO until Kaiko acquired it in 2024. And Valour has an index ETP. Winter built an index for Valour in 2021 in February, a top 10 index. So that is something that investors can find on Avanza, Nordnet, and other places. If they just want to own the market instead of knowing which crypto assets will ultimately succeed. Will it be Solana? I mean, Solana last year had more revenues than ETH, 2.5 billion versus 1.5 billion. Okay, do I want to own Solana? If you look at Valour's AUM, we have more AUM in Solana than ETH. So you can try to just get out of the guessing game or the coin picking game and just buy an index.
Yeah. Very interesting comparison you've made was with Ethereum, between Bitcoin and Ethereum, and how institutional loves Ethereum better, more than Bitcoin, and everything that Ethereum has to offer as a blockchain to disrupt the financial market, all the post-trade infrastructure. That says a lot about the appetite of institutions. And but clearly, like the institutional adoption doesn't come alone. It has to come with a certain regulatory framework, and that's what is also interesting here in Europe and with you guys on stage, is that we have different framework running in parallel. So on one side, typically we'll have MiCA, and that's typically Safello, which is serving like as a CASP, so that falls directly into MiCA requirements. So you provide the platform, the exchange, and potentially you could provide any crypto asset services from custody, staking, execution, and platform, anything like this. And on the other side, we'll have Virtune and Valour. So that's a very interesting point we will discuss right now. It's how those two regulatory framework can work in parallel, what the pros and cons, and maybe I'll start with Frank on this one. So Frank, you're the only Swedish MiCA exchange, and typically it comes with some cost. I believe in Q1 this year, like it was quite costly. I don't know how much it impacts like the result in Q1, but clearly it comes with some cost. So how do you see this potentially as an advantage compared to the others, or it's just a lead that other will catch up by 12 months from now?
I mean, they're wildly different products in many ways. So obviously, being a crypto exchange on the MiCA means you buy you can directly own, trade, send, receive crypto assets. So you have full control over. For the original thesis of what most retail customers got into crypto for is obviously that's what you deliver. Now the ETPs are interesting, particularly in Sweden, again, from an ISK perspective, that you just have the tax advantage, which is why by volume they have been more popular in Sweden. That's not necessarily the case in other parts of the world. There are quite a few, I think, places where it's direct retail trading. I think in China they don't touch any structured product. It's just everything needs to be directly owned. So what we see was exactly the distinction. What we're seeing in the market is where there's the go-to from a safe structured product within a regulated environment was just ETPs. It was the only thing that you could buy. Otherwise, you had to buy crypto directly, and there was just no framework for financial institutions to engage with it. So now that we do have the market in crypto asset regulation, that is changing across Europe. So banks are starting to move into crypto. For one of our other subsidiaries, it's called Atoma Studio, which is a compliance trading surveillance software that we developed to help financial institutions basically to be compliant with MiCA to do trade surveillance on the crypto level. We are actually seeing inbounds from tier 1 banks that want to go directly do spot trading as well themselves. So the whole shift is happening now. And then there's, of course, the long tail, as we discussed, like the family offices, asset managers, they might not want to have all those capabilities because, as you pointed out correctly, it's not an easy thing to do. And MiCA served as a real filter already, like to just get to that bar. But then you have the deadline in July, I think the 1st of July, where basically if you don't have the MiCA license, you need to cease your operations. So yeah, it is worth something to do directly. And I think there is a basis where now the institutions are going to go directly, and that also has an implication, I think, for some of the ETP trading. But it's still, there's an effect from going from, what is already known, what is already traded, to doing direct crypto, and that will take still time. And the Nordics have historically not been the fastest moving on this particular direction, but it is happening now, and it is changing now. And I think for us, of course, we're excited that we're right there, and then we'll see how fast that goes. I don't think ETPs will go away. I think, but at the end of the day, if you can hold the real assets directly versus and then at a tax advantage setup, that's the hard part in Sweden. Or you have a structured product, then of course, like the index products, I can see it. It's kind of easy to trade, but I think there's going to be an increasing demand for direct ownership.
Okay, thank you. So then to Frank to Chris on the other side.
Probably going to disagree.
Yeah. So your products are MiFID II instrument, so listed on regulated exchanges across 6 exchanges, 6 countries. So that clearly gives you like a distribution reach and proper regulation to operate. But here's the challenge that on the other side is, how do you actually support institutional demand when they come to you and then potentially need custody, they need staking, they need like all those embedded services. Do you see that this as like a blocker potentially, or a challenge, or do you see like some consolidation around this? What's your view? And I'm curious to see like the gap that you see in terms of for the adoption.
Absolutely, absolutely. And I could begin with just emphasizing what you mentioned, that crypto ETPs are regulated under the prospectus regulation with ESMA as well as MiFID II. But looking at MiCA from a crypto ETP point of view, it is something very positive, because even though crypto ETPs has actually been regulated since before, the underlying ecosystem in the form of market makers, custodians, staking providers have not been regulated within the European Union, and now they are. So we are certainly seeing that with MiCA falling into place, that is helping us in our dialogues and processes with some of the big banks here in Sweden and other form of institutional investors. So we see that as very positive. And of course, if you look at the Nordic markets, the Nordic financial markets is also fragmented, just like the rest of Europe. We have different central securities depositories. We have 4 different currencies, and so on. So that is obviously to some extent a challenge for ETP providers to bring the local access in the right way. But despite that, we, for example, are seeing increased traction in across the other Nordic markets, despite the fact that there is no tax wrapper like here in Sweden. So that clearly shows that ETPs can be a very attractive way, even if you don't have a tax wrapper, to invest into crypto. And one reason for that also is that ETPs can sometimes also be cheaper when it comes to spread, the commission fees, and so on. So it is also a cost-efficient alternative in many ways. And when coming to institutional investors, I fully agree with Frank that some institutional investor will want to set up their own custody infrastructure and so on. But I believe that there will still be a large part of the institutional target market for crypto as an investment that will prefer to invest through regulated investment channels, through a well-known investment vehicle in the shape of an ETN that is, in the end of the day, similar to, for example, investing into an ETF, because that means that investing into crypto becomes very seamless, easy, and secure.
Okay. You've mentioned like the specific across the Nordics. Obviously, it's clearly you need to comply with each requirements, and so I think it's maybe for Jacob was with Valour having like a broader footprint in Europe, including like expansion in the UK. I guess it's quite a challenge to comply with regulation. So maybe for Jacob, if you want to give the mic, what's your clients tells you about like the regulation, and where do you see like the main challenges? Maybe operational challenges, maybe just like how you see regulatory challenges across those jurisdictions at Valour, if you can tell us more.
Yeah, the fact that the exchange-traded products that we have issued are regulated and trading on regulated stock exchanges, of course, helps a lot, and in many cases is a prerequisite for the investors to be able to allocate at all. They wouldn't be able to touch these products. They wouldn't be able to touch physical crypto or holding it themselves, whereas these products fit nicely. It trades like a stock. It fits into the same reporting system as stocks and ETFs. So therefore, it's the regulatory status is something that they couldn't live without. And when we say that our products have a lot of regulations around them, I think it's useful to talk about the base prospectus, because that's ultimately the most important document. And it's a long document, but it stipulates what we have to do, and we need to comply with existing regulations like MiFID II, and some of the things that are laid out there are definitely for investor protection purposes. For example, if we have certificates or exchange-traded products tracking the price of, for example, Solana, then we must hold 100% of that Solana ourselves. Otherwise, we couldn't fulfill the promise that we have made to pay out to the investor the return of Solana. So this is clearly stated in our prospectus. And in fact, we have more than 100%. In addition, we have the cash buffer of 100 million that I mentioned earlier. So this is something that if the investor want to know exactly what am I buying, then these documents, the KID, the key information document, the prospectus, is a good place to look at. For us, for example, it also stipulates what happens if we get hacked. So in Valour's case, we still need to pay out the coins or the return of Solana, even if somebody steals them from us. I do not know how that exists or what happens in other ETF or ETP issuers' prospectuses, but that's what's happening in ours.
Thanks. Yeah, thanks, Jacob. I think I believe we are running out of time, and I'd like to wrap up and say a few words. Even though like regulation is a very exciting topic, we would be super keen to get like the last topic, and maybe that could be like the conclusion for each of you about like what's next. So we say we have ETP, we have staking product, we have index ETP, Mika also giving exchanges kind of institutional credibility. US has spot ETF, now moving into derivatives. UK just opened like retail access. AI is now reshaping all industry, including blockchain. So curious to know what's the next wave of crypto investment product in Europe, and for you personally, and maybe that will be also your conclusion. 1 minute maximum each, if you don't mind. Apologize.
We have a lot of crypto ETPs that track the price of AI tokens, and if you believe that AI is here to stay and is an important technological advancement, then you can invest in those ETPs to profit from that. Of course, at the intersection of AI and crypto. Personally, I think AI will cause unemployment among the high income earners, and that will have massive effects for what happens to credits, knock-on effect on the banks, as well as for tax revenues and the deficit of big governments. So I think this is a massive investment opportunity for crypto assets generally.
Thank you, Jacob. Frank, maybe about Tao and Bitcoin.
This was the most exciting part of the talk, where we could talk about artificial intelligence. All right. Well, yeah, I've been quite excited about BitTensor. That is this protocol that has basically taken everything that is great about Bitcoin, but it changes the consensus algorithm of proof of work to proof of intelligence. And it's a really novel way where you essentially, we talked about index product, you buy the token Tau, and it represents these 128 subnet essentially, which you could see as all individual tokens themselves. And it's already revenue generating, and it's doing very cool stuff, whether it's like drug discovery, climate modeling, inference. The largest subnet is responsible for the majority on the OpenTensor network in terms of inference. So it's a very exciting protocol, and what we did is take that protocol and the token Tau that you can stake, which means you can earn a yield, and we put that in the ETP. So when you buy our stake Tau ETP, you not only buy the Tau, but you also get the yield from it, which basically offset the whole cost of the product and then some. I think we are now at 6% on an annual basis yield on it. And then you have the upside of the asymmetrical like bet on decentralized AI. So I looked at all the different AI protocols, and I'm just very, I think it's by far the most interesting protocol, and I can talk about it for hours, but I will not.
Thank you.
But check it out.
Thank you, exciting. Chris, maybe, or do you see also some demand for more sophisticated products?
Absolutely, absolutely. So I think one category where the demand will continue to evolve is once again within index products, and certainly with thematic exposure to different emerging areas within the crypto market. But I also think as more institutions are moving into the space, I think the demand for more sophisticated strategies in the form of covered calls, capital protected products, leverage products, and other form of strategies will certainly continue to evolve. So it's going to be a very interesting market to follow, of course. But also there will also be new crypto assets that is serving strong use cases where there will be a lot of demand. Where we, for example, year to date, we can see that Hyperliquid is actually the third asset that has drawn the most net inflows across all assets in Europe. So that's quite an interesting development as well.
Awesome, ladies and gentlemen. So thank you very much. 3 entrepreneurs that are actually not only talking about the ecosystem, but that are actually building and making it. So a round of applause for those gentlemen. Thank you very much.
Thank you very much. I could have said it better myself. So moving on to our next panel, because fun thing, or not fun, but my colleagues find it fun. I joined the Nordic Blockchain Association team almost a year ago. I don't own any crypto or digital assets of any of the sort, but one of the things that can get our community kind of hot under the collar, that can give some really passionate discussions, is portfolio strategy, particularly Bitcoin versus diversification. So with that, I'm very happy to welcome on stage. We have Elena from BitGet moderating this panel, and then we have Nicolas from Bybit, we have Carl from XBTO, Quentin from Six Monks, and Pascal from Merki Baumann. Give them a big hand.
Are we ready? Perfect. Good afternoon, everyone, and thank you for joining us today to view our panel. As mentioned, the topic of our today's conversation is portfolio strategy, digital assets, Bitcoin versus diversification. Before we get into the discussion, I think we will start with some brief introductions of each of us. I will start with myself. My name is Elena Gonta. I am a senior institutional manager at BitGet. I do work with institutions across the digital assets market. These are funds, market makers, trading firms, brokers, OTC desks. Also, I am a regional ambassador of the Association of Women in Crypto. It's a global community empowering women in crypto and Web3. I'm genuinely excited to be here with this amazing group of panelists. Each of them do bring a different angle to the digital assets and the institutional business around it. So I would like to ask each of them to introduce themselves. Nicolas, would you like to start and we can continue? Oh, okay.
Thank you. So my name is Nicolas. I work with Bybit. I look after policy, which means half of the day I spend talking with the governments, explaining to them what is crypto, and then I speak with crypto people, try to explain them what is government. And fortunately here in Nordics, I don't have to explain what is government, and you know, you have a lot of government in Nordics. And I had the opportunity to speak with Finansinspektionen today, and it seems that you have a government who actually understands well crypto. So fortunate to be here, and we as Bybit were very active in Nordics. We have our country manager, strategic partner, Gustav Buder here, and we're really excited to be here.
Thank you so much.
Thanks, Elena. Pleasure to be here again. It's always good to escape the heat in the UAE, and no pun intended there when I talk about the heat. But I'm the Chief Commercial Officer at XBTO. We're a digital asset firm that has been around since 2015, regulated in Bermuda and in Abu Dhabi. And we focus mostly on institutional and professional clients offering regulated custody and trading, as well as asset management services. Looking forward to the conversation.
Good afternoon, everyone. So I'm Quentin from Six Monks. Six Monks is an alternative investment fund manager. We are a third-party manco. It means we manage investment funds that invest in crypto, but also private equity for different fund promoters. So we do see a different strategy around crypto. And what makes us unique is that we are today first or only authorized AIFM for third-party management company services for crypto. So the only ones that can help promoter to have regulated fund in crypto.
Nice. Yes, also excited to be here. My name is Pascal. I'm from Switzerland. I work for a Swiss bank. Merki Baumann is its name. It's been around for almost 100 years. In crypto, the bank has been for the past 6+ years, and we're mainly providing corporate clients with bank accounts, traditional fiat services, but then also ventured into more crypto linked services like borrowing against Bitcoin or just other things. You can buy and hold Bitcoin with us. Custody is very important. And my role, I'm an investment manager at the bank as well. I actively manage a portfolio on behalf of our clients and have been doing so for the past 2 years. Yes.
Perfect. And thank you so much again for the introductions. Now let's start with the first question. We agreed before the panel that we will have an open discussion. So let's see how this goes. So the first question is Bitcoin still the main institutional trade, or are investors now seriously looking beyond Bitcoin?
I can try and take a little bit more provocative approach just for entertainment purposes here. So, if you want guaranteed returns, there are two things that you should do. One is you should invest in education of your children, and two is buy flowers for your wife. And that's the guaranteed IRR and the best return you can get out there. Now, if you have some money left after that, which you shouldn't because education is expensive, so are flowers. Now, you should build a portfolio of different assets, and digital assets would have to form a part of it. Technology has changed, but economic theory hasn't changed, and you should be diversifying, including your portfolio and the digital asset portfolio with Bitcoin making a part of it. Now, two things will be affecting it. One is the infrastructure. And this is very clear that although digital assets will make a part of portfolio, it may be a small part, but what we see globally, tokenization will affect the way the traditional securities are being traded and settled, and a number of them will be moving on chain. And I believe that this is a global trend. We see very different positions from different jurisdictions, and myself as a European, I'm from Lithuania, I hold myself European, so I'm allowed to criticize Brussels a little bit, not too much, but every day. And whilst Brussels has been building these regulatory sandboxes, US and China has been going straight for the beach. You look at the tokenization that's been pushed on NASDAQ full force and New York Stock Exchange. Same thing for China through Hong Kong, using the government digital currency to settle. So those things will make a major change in terms of how we invest. And number two is products. And we've heard here a gentleman talking about prediction markets earlier, but I would strongly disagree with him. Take a very, very simple example. If you hold a portfolio of Scandinavian banks and you want to hedge against moderates losing in the general election in September, no prejudice, but generally social democrats tend to increase spending. They need to cover the spending, they need to increase the taxes. That may affect the portfolio of banking assets. How do you hedge it? You go into prediction markets and you buy a security, a tradable security, which forms part of the digital assets. So I believe the two main elements will change. One is the infrastructure, and two, we will see prediction market products coming into play under MiFID. Not gambling, but MiFID. And there are many good reasons why, and may I talk about a little bit more later.
Thanks, Michaelis. To answer the question, I think we are still at the stage where institutional investors are looking at digital assets as Bitcoin still. And I'm very fortunate in my role to meet with all kinds of institutional investors, from sovereign wealth fund to family offices, private banks, asset managers. And I'm going to break that maybe in three phases, how I've seen the evolution of Bitcoin adoption in the last 24 months. We first had the ETF moment. We talked about ETF on the panel before that, which happened 24 months or so ago. Largest and most successful ETF launch in the history was BlackRock's IBIT. At the time, investors were looking at, it was the easiest way for them to access, right? Suddenly you have a ticker, you can put it on the screen and just allocate to it. The second phase we've seen is moving from the ETF to direct custody and active management. And I see that more and more in the conversations I have today with institutions, which are getting more and more comfortable with the custody solutions out there, which are more institutional grade the likes of Merky Bowman and other banks are already offering custody of Bitcoin to their wealthy clients. But once you hold an asset on your balance sheet, no allocator wants that asset to be dormant and just sitting on the balance sheet doing nothing, right? If you look at cash today, any one of us would invest it into fiduciary deposits, money market fund, generate some yield. When you hold equities or fixed income on your balance sheet, you also then look at how do I enhance my yield, and you put structures around it, right? Principal protected notes or enhanced return notes. And I think that's what we're seeing now in the conversation we're having around Bitcoin. When you speak to a treasurer, the next question is, okay, I have the asset class, I'm holding Bitcoin, how do I put it to work? And there's a lot of education that needs to be done there because a lot of them do not realize how deep, for example, the options market is and how you're able to launch hedging strategies or even yield strategies. So today when we, as XBTO, speak to some of these clients or prospective clients, we're like, if you're able to generate between 5 and 8% in annual yield on your Bitcoin with only a 3% vol, they jump at it, right? It's one way, it's a way that they understand, right? Trading options is very traditional finance. So I think we're at this stage. The third stage of this Bitcoin journey, I think, is more than diversification in the type of strategies to access Bitcoin or to diversify away from Bitcoin. We're not there yet, but we're seeing a lot of traditional hedge funds that, as most of you know, have different strategies like trend following, market neutral, event driven, that are now applied and have been applied in the crypto space for a while. And that's one of our unique selling proposition is when you have an asset class that trades with so much volatility compared to others, that has a lot of inefficiencies, that trades 24/7, there is no doubt that any of these traditional hedge fund strategies or quant signals or algorithm, you run them on that type of asset class, you'll be able to generate alpha. And I think that's the next stage of the conversation. But we're already seeing traditional hedge funds that are now starting to launch crypto sleeves in their portfolio, acquiring digital asset management. Not long ago, we've got Franklin Templeton, which is a big traditional finance player that acquired Coin Fund or 250 Digital. You've got the likes of Cube, which is a big quant hedge fund out of London that is launching crypto sleeves. And I think that's going to be the path forward for institutions to access to that asset class in a more actively managed way because they know the counterparty and they're comfortable with them.
So I agree with what was said earlier from Carl when we speak about the adoption of Bitcoin by institutions, that they have started like that, and those actors will start always with something easy to understand. And today they have started to understand very well this asset class. But I would like also to discuss when we speak about institution, because I heard it a lot here, family office, sovereign fund, this type of actors. But the reality of an institution on capital market is that 50% is run by insurance company. Not once it was mentioned in the panel before, or not yet with us together. So if we would like to have adoption by institution, we need also to drive those insurance. On our side, when now to try to answer to your question, if it's Bitcoin only or we see with those actors other stuff, it depends where this institution is coming from, because you have some which are more crypto native than others. We see here a bank that already deal with crypto for 6 years, which is quite good. But some banks are only starting the journey. So obviously, if you start, you're starting with something easy. If you have started to understand everything, you are going to take the strategy Carl described, which are much more active and much more toward generating the most yield you can get with the asset you have under your portfolio. And that comes with derivatives and this type of very active strategy.
Yes, so I can also draw on our experience and then second what my gentleman has said before. I mean, in the end, for us, it's really if we focus on Bitcoin, or crypto in specifically, Bitcoin is still the dominant play. And there is obviously, for us as a traditional bank, we see it as a core satellite approach. We have all the traditional asset classes, but then we recommend our clients to take up to maybe 2 to 3% should take up your portfolio in the traditional, vis-a-vis the traditional as well. And so that's what we're seeing, and that's also where we see some demand coming from. And there, obviously, it's usually Bitcoin and Ethereum, the two dominant players that people end up with. Also because most of the people don't really care; they just want to have some exposure to crypto. When I then focus a little bit more on the crypto stuff, we also have, and that's the crypto module that I'm managing myself. There, obviously, I would like to go into other asset classes within crypto, or like the other tokens, altcoins, these type of things. But maybe we can talk about this later as well. It's just really hard because for the past couple of years, most of these, they're not investable assets in a sense that you can just hold them because they have not been able to outperform Bitcoin, for example. Then it's also some of those tokens, or most of the tokens, at least from what I can see, don't have a value accrual mechanism built into them, and so it makes it all very hard to have these things inside an actively managed crypto portfolio, which in the end ends up just with Bitcoin and a few core other things which are maybe just hype right now or hypey, but then you have to diversify out of it again. And so that's pretty much why I think we're still very centered around Bitcoin, and I don't see it changing that rapidly. One last thing that we're seeing is the crypto equities. Obviously, the companies that are within that space, you name it, the Circles, the Coinbases, the more IPOs we're seeing, these are also something that clients are interested in, and they are sort of now taking the place of traditional altcoins. But apart from this, I think, as I said, it's still very heavily Bitcoin focused.
Just to complement what Pascal just said about the infrastructure, it's very true that today we're speaking about trading other assets or others than Bitcoin. So it's something we do on a daily basis. But even for very liquid altcoin, for an institution, it's very difficult to have the right infrastructure to do it. Because when we speak liquidity, for instance, we speak about hype earlier, so very liquid, a lot of on the market. But if you look at what is available on a trading book of CASP, so a crypto asset service provider in Europe for this token, it's ridiculous. You can't trade it seriously on a daily basis. So it's fine to speak about other assets, but it's also very difficult when you want to do it at institutional scale with institutional regulatory obligation who go along with it, like custody, AML, KYC, and so on.
Thank you so much. And I think the first players to join crypto were the trading firms because they were ready to take the risks, the counterparty risk, the custody risk. Recently, I was speaking to a client, and he had been trading since 1989 professionally. And he said that crypto is a totally different game, but you have to be ready for the risks. Okay, thank you so much. And we're going to go to the next questions, which is, are institutions more interested in crypto as an asset class or as financial infrastructure?
Do you want to go?
Sure. Again, I believe that crypto industry has decoupled from Bitcoin. Bitcoin is great, but it's like Mona Lisa. There's no point in talking about it. Talking about it doesn't make it better. It's going to be there. People will be buying Bitcoin. It has the purpose. It serves the value. But the developed exchanges, what they've done, if you look at 5-6 years ago, was a lot about speculative assets. Right now, it's a lot about digital infrastructure. And what we're seeing today, a lot of tokenization products out there in the market. And it's very important to make sure that the products that are out there that are supported by the digital infrastructure are the true tokenization. Because out there's a lot of derivative wrappers. We feel like you own the Tesla share, but voting rights, no dividend rights, no true ownership there, and additional counterparty risk that you wouldn't necessarily want to have. So I believe that the true tokenization hasn't yet taken off, but we will definitely see over the next few years both digitally native securities issued on-chain and digital twins, which would underline the opportunity for diversification of the portfolio. So although we'll be investing in shares and bonds and private companies, that a lot part of it will be based on-chain. And we do a lot of business throughout different countries, and I've got so many different examples where, for example, in LATAM, we have family offices who approach us and say, would like to diversify our portfolio by investing in gold through tokenization in Asia. And we offer those opportunities. So I believe that digital assets will underpin, as a blockchain, will underpin the major financial infrastructure development. In Europe, it is taking place at a great pace. Outside of Europe, even greater. And I believe that this is something that will drive it. Second thing, which is also very important, is AI. AI will shape how those decisions are being made and how those portfolios are structured. And right now, when you want to make a decision to invest, so your interface is graphs and buttons. But what is already happening, and it's not future, it is already happening, that the new interface is the decision layer. So you have the intent and you say, I'd like to have crypto exposure over the next 3 months, and the AI makes it on your behalf, decides the time, the platform, the currency, the place, this custody, everything does it for you. The questions remain who takes the responsibility, whether it's appropriate, and the embedded volatility that comes into it. So I believe that several elements will be shaping it. And the last thing, which is probably more down to the retail portfolio management, a lot of wealth management companies will be going out of business. And we see that because they've been focusing on making people feel wealthy as opposed to building their wealth, conferences, dinners, travels, but the portfolio don't yield the results that people would like to. So what we see now, the trend in Sweden has been already for some time, when people manage their own portfolios, they go on their own, they have their own platform, and they buy the stocks, buy Bitcoin, buy other digital assets, and they make mistakes. They lose money, some make, but at the end of the day, they own their decisions. And that is the big changer. And I think that today people are much, much more prone to take risks, and this is exactly what they'll be doing, managing their own portfolios. So I believe that those several key trends, the infrastructure as the blockchain, digital assets underpinning all financial infrastructure, 2, AI, and 3, people taking their own decisions.
You're a tough act to follow when it comes to analogies, Miklas, and I would love to hear your answer to PM's disappearing Pascal in a bit, but I'll take the mic just to cool off maybe a bit. So the way I would answer that question, I think it's both. When we speak to institutions, they look at digital assets both as an asset class and as an infrastructure, and they're basically commingle with each other, right? You need the infrastructure to allow for more adoption as an asset class, and you need the adoption as an asset class to fund the infrastructure. So one without the other will not work. Now, to answer the question, it depends who you're speaking to in that institution, right? You have different counterparts. So if today I speak to a CIO or I speak to an investment committee, they look at Bitcoin or digital assets as an asset class, because what matters for them is portfolio allocation and portfolio returns. So the questions they ask themselves is, okay, how much should we invest in? How do we invest in it? What should be my benchmark and what should be my expected risk return profile? So these are the questions that they ask, and these are the questions we usually try to answer. And if we just look at, and we're not going to debate why Bitcoin is an asset class, but Bitcoin is uncorrelated to most of the other asset classes that any investor holds, or partially correlated. So if you look at the S&P 500, we're looking at 50% correlation. If you look at fixed income, we're around 20% in the last 6 years. If you look at gold, it's single-digit correlation. So that's the first benefit that any allocator should look at, is the uncorrelation, decorrelation from other asset classes. The second thing Pascal mentioned, how much should we invest? And that's a question you can now answer. There is enough data to look at to say, is it 1, 2, 3, 5%? And it really depends on how you're currently allocated. But even if you look at any single small increment of Bitcoin in a diversified portfolio, if you run that analysis, you'll be able to see that it will increase your annualized return while having very little impact on your volatility. So when you look at it from a Sharpe ratio perspective, you increase your risk adjusted return. And we recently, actually, on the back of all the conversations we have with institutionals, we recently launched a digital asset allocator tool that anyone can access on our website that allows you to model your own portfolio at the tip of your fingers. You don't need to come to us, or you don't need to speak to anyone else. You can just model your current allocation and start playing with what will be the impact if I add a bit of Bitcoin. Is it passive through an ETF, or is it an actively managed strategy? Now, if I speak to a treasurer, if I speak to a CEO or CTO, then the conversation switches more towards the infrastructure side. And there, obviously, it's a dream come true for a lot of treasurers. Again, you hold that they don't ask, should I invest? They're more like, how do we go about it? And today, when you talk about the blockchain, you talk about stable coins, instant settlement, 24/7, being able to generate yield intraday, not having to, every time you want to do an investment, having to wait 2-3 days before that fiat money arrives on the bank account for you to be able to trade, not having to keep the collateral on there for a few days, being able. So these are great tools and infrastructure that allow any company that gets into the space to be much more efficient in the way they utilize their capital. So I'll leave it there, but for me, it's an intersection of both.
I will start to answer to Nicolas for the disappearing of portfolio management team.
Wealth management, but
in fact, it's very true that there is a shift for individual to take their own decision and decide in what they want to invest and do it by themselves. And I believe the exchanges have done a tremendous work to help individual to access the capital market or the crypto asset directly. But if you go in a traditional investment firm, or you go in my favorite type of institutional client I want to see in crypto, so the insurance company, no one is going to rely on one single person to take a decision. It's always it needs to be a college of different individuals to do the decision. Even if you use AI to help you to take the decision, I guess you can get fired today if you answer to a question, why did you invest in that? I listened to ChatGPT or Claude. But if you answer the question that you have looked at the analysis produced by the AI and have made my decision for this and that reason, it's more genuinely a good thing. So portfolio management team still have a long future, in my opinion. And now to come back to the question, so infrastructure or crypto, a bit disappointing. I still agree with Carl on this one. But it's true, it depends to whom you're speaking, because if you're speaking to an actor like Clearstream, where his focus and business is infrastructure, obviously they want to use the blockchain to run their infrastructure and continue to maintain their ledger and continue to be the central place for exchange of assets among actors. But if you speak to an asset manager, and Carl described it very well, where you need to bring diversification, buy uncorrelated asset, obviously they are very interested by crypto.
Yes, drawing again on our experience, from our perspective, answering the question asked, I mean, yeah, you have many different, we are at a bank, we are not very keen on issuing our own products because we don't have our products, so that's why, obviously, again, the infrastructure question for us is not that important, even though we are being approached a lot by a lot of market participants out there, that's where we can see that a lot of things are happening. But again, for us, the asset management side is way more important. But then again, even there, as I said, it's quite difficult. You have the Bitcoin part, that's what Carl also said, that's where we let the numbers speak. We don't really do the education and try to convince people to invest into Bitcoin. You just show them the numbers and how it really betters and improves your risk-return ratio. And then these people are surprisingly hooked, even though it's maybe a 75-year-old guy from the Lake of Zurich living close by. So that's the interesting part. But then, I mean, also, when we then look further into maybe Bitcoin native people who have made their wealth with Bitcoin, and these are also some of our clients, there you can see that these people are interested in generating dollar-generated yield again, or just some sort of yield product. I mean, these treasury products out there, even though we don't take our own stance, and I don't want to judge these products, we see some demand there as well for stuff like Stretch and these type of products, even though they're very early. But you can really see there is some demand for this as well, but especially for people who are from the Bitcoin sphere itself, because they are already believing in Bitcoin, and that's why they can then piggyback on these sorts of products. And that's what we're seeing. And in the end, again, when it comes to tokenized RWAs, I think that's what's being discussed as well. Especially in Switzerland, we have a very good environment with the DLT law that's been in place for quite some time. We even had companies putting out technologies to tokenize your shares. We had many startups doing this, and it hasn't really taken off, you know. And yeah, we as a bank would like to be supporting this, also to provide it to our clients, but demand is not there. And I believe in the end, it's also because with many of these products, the business case is just not there, even though it might be legally fine and technically everything is fine. If there's no economic business case, you don't want to invest into the butcher next door, because it might not be the most interesting investment case, and then it doesn't help if that butcher has sort of tokenized its shares. And that's why I think there's always also this sort of limitation that even though it would be possibly technically and legally, the economic case is not there, and that's why I think we haven't seen so many projects coming to fruition there. So we end up being in the crypto space again.
I just want to say something that might be a bit controversial here, but you made me think about something. I mean, for me, a year from now, I think we won't make a differentiation between digital assets and traditional finance. I mean, you won't be talking anymore about crypto and traditional finance. It will be traditional finance on crypto rails. And I think that's the only way forward for the industry to thrive and to really hit that point where you have this institutional adoption. I mean, it's no surprise today that big institutions only started to buy directly Bitcoin and do custody using traditional finance players, traditional banks. You've got the likes of Standard Chartered, you've got BNY Mellon, and all those big banks that already work with institutional clients. So there's already a relationship, there's already the due diligence that has been, there's already a third party. And there's also the other types of businesses you can do, right? Today, custody is a commodity. And no institution expects to pay for custody. So if you're a crypto player offering custody services, which we are one of them, it's definitely not a service we'll be able to win, and not something we would offer for free. But when you work with a Franklin Templeton or a BlackRock and you make revenue on the ETF, you can afford to offer custody for free to those institutions. The same for wealth management clients. They come to a bank, Marky Bowman, or other banks in Switzerland that offer custody and have been doing so for a few years. Now, they do charge quite a lot, but those clients are willing to pay for that. They get other services coming from the bank, right? And we partner. I mean, we are at this stage where, as an asset manager, we do understand that we need to partner with traditional institutions. And we've done that with a bank in Switzerland. We're hoping to do more, where a client trusts the bank for the security, the safety, the investment advice. But then the bank, like Pascal mentioned, doesn't have the expertise to run, for example, some of these strategies. So they come to us to be able to manage that for them and at the end on the behalf of their clients.
Can I, for a change, agree on what was said? So I fully agree that we won't have that distinction at TradFi and digital assets. It's going to be all one financial industry. But there are some particular reasons about it, and what are we going to do next, which is really important to my mind. Is, we've been hearing a lot about crypto companies saying that like they're gonna disrupt traditional finance like never before. But reality, that many of them are not even at the table; they're on the menu as traditional finance are eating them up by offering the services that we heard. All major banks are going into the crypto industry and offering these services. And if we continue on focusing on doing same things that we were doing 2, 3, or 5 years ago, in many instances, working around Bitcoin and finding new strategies, I think we're going to have tough time competing. And I think it's therefore ever less important in trying to go back to the origins of the blockchain ecosystem, communities, and then building new products. And I believe that one of those that was mentioned before is prediction markets. Based on blockchain, smart contracts, no treasury, no custody, 2 parties enter into the contract. The minute it's entered into the contract, it becomes tradable, mark to market, behaves like a security, could be potentially MiFID treated, which means market throughout Europe. These are new opportunities. These are new blockchain products. And they're growing like crazy, like never before. So I believe that we have to be very open to new opportunities. Of course, Bitcoin and the traditional ones will be sticking there. But what are we bringing next and new to the industry, which will define us?
Thank you so much. I also want to mention that based on our discussion, the main question is not about Bitcoin versus diversification. I think that the main question is, are institutions able to build their digital assets exposure into portfolios that maybe are liquid, hedgeable, scalable, and operationally safe? We also have different institutional players who solve different problems. We have funds, trading firms, market makers, and each of them, they have their own goals. And that applies to digital assets market as well. I guess the main conclusion is that do we have the infrastructure that does allow, which is mature enough for institutions to allocate, manage their risk, report, hedge, and scale that digital assets exposure as part of their business models? And with that in mind, I'd like our panelists to maybe share their thoughts in one sentence. What do they think that institutional investors should think about digital assets portfolio maybe in the next 12 months?
I think that they should be looking at new opportunities, because there are plenty of new products out there, and look at how to combine them, how to make them properly fit into the portfolios that they manage.
Yeah, I mean, there's no right answer for all. I think it really depends on each use case and how you're currently invested. But at the end of the day, I think the key word here is diversification. I think we're at a day and age where you can no longer look at yourself in the mirror and say, I haven't invested at least a small percentage in the asset class. When we speak to the sovereigns, their role is to manage the wealth of the future generations. How would you explain to a 25 or a 20-year-old 10 years from now that you haven't allocated to the space when it's something they've grown with, right? So again, diversification, it's an asset that's here to stay. I'm not saying you should invest all of your wealth in it. I can keep money for the flowers. And for what again? Education of their children. So put some Bitcoins aside. But yeah, just look at it, look at the data, and see what makes sense in your current asset allocation and your risk profile.
I agree on the diversification piece. We need to continue to look at the new project and building the ecosystem. And to make the link with your point on the infrastructure readiness, we still have I believe today there is a solution for handling approximately any type of crypto strategy. But to bring that on an institutional regulated level, it's tough, and you still need to partner with a lot of different actors to be able to have the solution that will meet the requirement of the institutional actors. So if one word to be kept is a partnership among institutional actors.
Yes, maybe one specific thought to finish off. What should institutions be looking at? Carl mentioned it, generating yield on Bitcoin. That's really something I think if you are able to generate native yield on Bitcoin and you can do it at scale, I think that will be a 10 trillion or whatever opportunity out there because everyone is looking for this. And so if you manage to do this as an institution, you find the appropriate players that you can team up with, then I think you're really well positioned in the next 12 to 18 months.
They're already doing it.
And we don't work together yet. Disclaimer.
Oh, do you want to add something?
No, I'm good.
Okay, well, thank you. Then on this note, I want to thank our panelists for sharing their thoughts, and I want to thank the audience for joining, listening, and learning what we had to say today.
Thank you.
One. Perfect. So moving swiftly on, but still staying on topic when it comes to the institutional adoption here in the Nordics. So this is one of the firesides that I've actually been looking quite forward to because SEB is one of the Swedish Big Four banks and one of the largest banks here in the Nordics. And I've been really excited to hear their thoughts on the on-chain transition of banks. So let's welcome to the stage Christopher, co-CEO and co-founder of Defense, and Staffan Larsson, who is the Chief IT Architect at CBS. Let's give them a big hand.
Thank you. All right. Can everyone hear us? Yeah? All good? Thank you for being here. Staffan.
Thank you for having me.
Thank you, everyone, for attending this session. So, yeah, we're not going to, in this session, it's less going to be about promoting, hyping up Bitcoin and other ETPs and ETFs and getting into the labyrinth of banking architectures, adoption of innovation within these hyper-regulated environments. And SEB is, I would arguably say, the #1 bank in Sweden, right? The biggest bank. And we are very happy to welcome its chief IT architect for business and retail banking to discuss, well, everyone's talking about it, right? Moving on chain, adopting digital assets, but how will it actually work? How will it actually step by step materialize itself? So I'm the co-founder of a company that's doing core banking systems for digital assets, and so we have a big stake, and we have had a lot of time to observe this space mature over the past 6 years. But first, before we enter into these topics, why don't you present yourself?
Oh yeah, sure. So Staffan Larsson, currently I am heading up a team of architects for what we call business and retail banking. That is all the private customers, so individuals like yourself, and companies up to revenue of 500 million euros, which is a pretty substantial size here in Sweden, at least. We operate primarily for private customers in the Nordics and the Baltic countries. And for corporate customers, we are pretty much all over the world. Of course, with a focus on the Nordics market, but still present in most major markets in the world. So that's us. And yeah, who am I? If you look at my LinkedIn profile, which you can of course do, you will see that I've been a bit all over the place and it doesn't look super structured, but I have been working with digital transformation and digital change basically all through my career, even though I've been in the fashion industry at H&M, I've been in the heavy equipment industries, lately at Atlas Copco, and now currently I moved into the financing industry working for SEB. But the common factor in this is all about digitalization, transformation, and especially basically developing software for best practice in the industries.
Right. Yeah, I'm old enough to have seen an industry that was very rebellious in the beginning. I call it an industry. It's not even an industry, but the blockchain technology was promoted in a very rebellious fashion in the early days. And it's reassuring to have you here saying that it's akin to digital transformation. It sounds almost like we're getting into a cloud era where it's over time going to happen.
Yeah, sorry for using
no,
that.
No,
Maybe
it's
an
good.
old
It's
term.
Good. And so just maybe a softball to start. What is the difference between building software, developing software, and bringing innovation inside a bank versus H&M or a normal company?
Yeah, I would say there are a couple of differences. Some are the ones that you think of, and others are not what you think of. So the ones you think of course, would be we are highly regulated, we are under DORA, we are under GDPR, we are to some extent under MiCA, we are under all of these, and that puts a lot of effort and to be honest, consumes a lot of our development power and capacity. But the other side of the coin, and maybe what was the reason for me moving into this, is that it's also an industry which totally relies on IT and technology, and who are willing to invest in new technology. So basically, I mean, this theme of today, blockchain, that's one technology. AI, of course, is another one. I think we are going heavily into all of these. We are doing a lot of things across the board. And I don't think you get to see that in many other industries, at least not here in the Nordics.
Yeah. Many skeptics would say, a bank like SEB is doomed to have all its customers stolen by Revolut or Lunar, who have their offices here, et cetera, et cetera. How would you receive such a comment? And maybe the other way of asking that question is, where do you want to take SEB into 5-10 years? Where do you want to see the most changes happen?
Yeah. Well, first of all, there are a lot of niche banks, but you don't see anybody really moving into being a full-service bank. And I think there are reasons for that. It's not that easy. And actually, banking is built upon long-term trust. And I think once you have earned that on a market, that is something which is really hard to compete with. So that would be one statement around why maybe I think the big four or big five are still going to be on the top 10 list at least for a long term. But it's also important, of course, not to become fat and happy and just relax and lean back and say that those modern things are not for us, we will stick to the core. We can't do that. And moving into becoming relevant, we are very big when it comes to corporate banking. There, I think we are kind of the default bank. When it comes to private banking, we are not. And we need to be, and we want to be. And by doing that, we need to become more digital native, I would say, because today it's really a bit too cumbersome to do some things with the traditional banks compared to the niche banks. And we need to overcome that. And I think with the big shift that we are doing, there is actually a chance of us moving quicker now and actually, becoming very competitive in a couple of years from now.
And you see, when you say competitive, you see that the stress factor and the forcing function that is urging you to say something like, we need to digitize, we need to do this, we need to do that. Are they coming from the customers themselves? Is it coming from regulators that top down tell you need to do this and that? Is it coming from the swarm of agents that everyone's foreseeing? Like, where do you see the biggest
They come
driver?
from all over. I mean, we can never neglect regulators and the requirements they put on us. And for some weird reasons, it is always very stressful to implement it because even though we know of them well in advance, the last months before something needs to be in place, it is kind of stressful. So we can never neglect that part of it. But to become relevant, I mean, nobody will choose a bank because they are regulatory compliant. Well, that's kind of a health factor. You just should be. So it is about being giving an experience, which I think, especially for, I mean, the generations that are now growing up totally with used to, I mean, doing everything digitally. You cannot ask people to come into an office and sign a paper for doing something which everybody else offers to do digitally. So it's about doing that and be truly fast when it comes to things like giving a mortgage for somebody standing and looking at a really nice apartment they want to buy, for instance. If we do that and we build on the trust we have, I think we have a really strong position.
As a critical technology provider, we go through a lot of these long sessions, quarter-long assessment, due diligence, RFPs, etc., procurement sessions, and so we see part of it. We see a bit of what's happening, but we also know that we're just one vendor among many others that sit inside a gigantic kind of target architecture within this process. And so there's just so much more that's being done. We're like pitching and explaining and spending these months educating on our solution and what it can do and how it fits inside a bank. But we also know that, you know, there is so much more to do. If we just, for the audience sake, can break down, do it as you want, but like let's take one innovation that you might have touched over the course of the past year. Like, what does it look like to introduce innovation within the bank? Who are the stakeholders? How many meetings in average do you need to have before you actually hit the road? Who are the regulators you need to?
How do you get it done?
Yeah, like how, if you break it down, like what does it really take? What does it look like?
I can give one example, which we did only a couple of weeks ago, honestly, where, I mean, we have all seen, well, partly in my role, one of the things I have to do is to stay alert on all technology development and make sure that we are embracing them once they come. And of course, we are working a lot with AI. When it comes to software development, taking the shift and moving into AI for software development, for software design, for software requirements, testing, test automation, all of this is happening as we speak. But we really saw that growing. Everybody did it on an individual basis. We provided a lot of tools for them. But instead of doing this, we started in, I think it was February, we set up a process which was going to end up in a big hackathon where we took 130 people, out of which 110 were actually business people who were normally dealing with allowing loans for maybe investing in a turning machine in some workshop in the south of Sweden. Now, all of a sudden, they were sitting in front of a software development toolkit and were asked to build a software solution. But by investing 4 hours in training them in this, they were up to speed so much that they understood the concept. And bringing their business value and understanding into this actually made us, during one day, to build a fully functional ledger with a customer interface for self-service on top of it in one day. Of course, we couldn't take that immediately into production, but it opened up a mindset of the whole thing and a way of embracing these things, because we got everybody on board and understanding what it was about. And currently, we are actually out of this running to pilots. If anybody here is going to buy a house in some near future, have a look at how to get a loan, and you might see the new things that we just did for that.
Cool. So the expected outcome, I guess, more speed, easier UX, smoother processes, end to end.
For sure.
Yeah. How does blockchain creep in into SEB over the next years? Is it at all creeping in this year or
of
not?
course. I mean, we are active in the Euro stablecoin initiatives. Of course, that I think will, I mean, in a couple of years that is going to be de facto there, which means that we will have a lot of much quicker settlement when it comes to payments and transactions, which is super important. And I think that is something which, when we look back a couple of years from now, we will all say, why did we do all of these things we do today? But then I think there are other things going on, and especially around tokenizations of assets for instance, collateral for loans. I can give someone, if somebody here is working with that, then maybe a lead for you. And if you are in Sweden, you know this, but if you're from outside of Sweden, maybe you don't follow Swedish news. There was a news on the news a couple of months ago about a man here in Stockholm who had bought an apartment for millions, and he was really happy living there for 6 months until somebody called from a bank where he wasn't a customer, and they said your loan is defaulted, so now we need the money back, or we're going to take your apartment. And he said, I don't have any loan with you. And the fact was that actually there was a loan with this apartment as a security, which was still there from the previous owner, who had disappeared. And I think that shows a problem. And I know that there is a new legislation for kind of a governmental registry for properties, which is going to be there. It is already in place for houses, and I can give away a secret. I hope nobody's here from Lantmäteriet, but if you work with them, it's like going back to 1980 or something. You do things per post and email. Email is like digital super working with them. And now this is going to be implied a registry nationwide for all properties, including apartments. I really hope that we come to see some of these technologies there. I think that's one example of where you see there are real business needs for getting a much better carrier of information, if you like, in place.
And do you see such a registry get into, I mean, classic databases, sure, digital, but classic databases? Or is there a world in which you see this leapfrogging onto blockchains, private or public? Or is that too much of a jump?
No, maybe because I'm a tech person, but I would see that as a school book example for when to use blockchain, honestly.
And would that title of in the registry, that the ownership title of the flat, of the apartment, do you see that as a collateral, as a token that can be collateralized, or would you see it just as an identifier? What would be the for you the most exciting kind of development of such a digitization?
Well, for me personally, of course, going the full way and getting it collateralized. But I mean, this is really early on. But I'm saying that is one example, and I could see others when it comes to working with leasing, for instance, also there for collaterals and securities within leasing. And there are plenty of others. Some could be done internally by a bank. Others are probably better done by some external like agency in that case.
It feels a lot like there is a chicken and egg problem as well in this whole adoption cycle, because everyone's in some kind of wait and see game, just looking at each other and seeing who's going to move first, who's going to do the first thing, etc. And even if you have someone doing the first thing, it's just going to be like, we're going to observe, see how it plays out, negative, positive outcome, analyzing that, etc., and not moving until actually there is some stress factor, some forcing function, etc. SEB being one of the biggest banks, if not the biggest bank in Sweden, do you see that as we need to lead by example, or do you see it still as, well, we need the whole herd to move before we can move ourselves?
I think in order to grow and in order to not only preserve, I think we have to be a leader in certain cases where it makes most sense. And honestly, typically these things, I don't think any large bank will bang the drum and say, hey, we're all going blockchain and we're doing everything on that technology. But underneath, and I even heard somebody refer to in another speech here saying that developers sometimes even hide that they've used blockchain technology because they don't want to get associated with somebody from the business side coming and saying, are you doing a crypto thing? That doesn't sound very serious and secure. But I think if we allow that to grow and use that, for certainly I see these technologies playing a really important role without us making a big fuss out of it.
Do you see? Have you been in touch so far? I know it's only been a year that you've been at SEB, but have you been in touch so far with Riksbanken? And have you any views on the e-krona initiative or not?
To be honest, me personally, no. It is of course discussed, but I think you could also see us engaging in the euro stablecoin as kind of an indicator.
Yeah, 100%.
Yeah.
Will this year can one expect that SEB will start issuing euro stablecoins and holding them and using them, or will that eventually happen only next year?
That, to be honest, is a bit beyond my knowledge.
Okay. All right. I think unless you have any last comments, we're almost out of time. So maybe some time for questions. Yeah.
Of course.
My accounts were frozen by Swedbank when I was dealing through eToro.
Mm-hmm.
Would you be interested to have me as a customer?
Well, we have a know your customer process, of course. So if you fulfill all the regulations there, I'm sure we're happy to onboard you.
I was cleared after I showed them all the papers and all the paper and, all right, thank you.
Yeah.
That's it.
Can I ask, as somebody who's not been following the Swedish news, did the man get to keep the apartment?
Yes, he did.
I just want to know it's a happy ending.
Yes.
All right. Well, thank you very much for listening. Thank you, Staffan, for being here.
Thank
you. It was a pleasure. Thank you.
Amazing. Thank you so much, guys. Let's see, moving on swiftly, we are ready for a next keynote. So, as we've heard today, geopolitics is such an unavoidable factor, and within many of the dialogues going on here in the Nordics as well as the EU, geopolitics, digital sovereignty, digital resiliency are such important topics. And when it comes to the interplay between money, digital finance, AI, and trust, it can become quite complex quite fast. So help me welcome onto the stage. We have André Meisen, CEO of Bitcoin Swiss.
Hi. Thank you very much. Thanks a lot for having me, and a warm welcome to my presentation. Hard money, hard choices, and why sovereignty matters now more than ever. As already indicated, and I guess here you see the logo, Bitcoin Swiss. Yes, I am Swiss, so what am I talking about? Sovereignty here. Sovereignty in Switzerland is basically the state of the art. We have a direct democracy, we have power with the people, sovereignty with the people. We have, I would say, a fairly stable currency as well. So why am I talking about sovereignty? Well, Switzerland is probably rather the exception. It's a small paradise, so to say, and of course, not the entire world is working the same way. So if I go to the first chapter of today, a world losing stability. And I would like to invite you towards a couple of arguments in order to not just make you follow the presentation, but also to do some sort of self-reflection and start to challenge a little bit the status quo. Because sovereignty is something that needs to increase, especially if it's about sovereignty over money. And what exactly do I mean with that when I say a world losing stability? So one topic that I would like to highlight is governmental spendings, especially for global defense. Of course, super unrelated to the sovereignty part, but we come to that in a moment. So in the last few years, global spendings for military and defense budgets have been rising in over 100 countries at the same time. Global defense budgets are already like on $3 trillion, and 1/3 of that is allocated towards the US. And we are shifting slowly away, and of course every NATO member has seen that as well, from a multilaterally kind of world towards more a unilateral world, and that is of course challenged by the famous president in the US almost on a daily basis by now. But going a little bit back towards the history, if we look into a quote from famous US politician and diplomat Henry Kissinger, we of course see that maybe the current behavior is not that off, because at the end of the day, Henry Kissinger said that America has no permanent friends or allies, it just has interests. And I think the current administration is living this almost on a daily basis. So that brings us to the next topic, which is sovereignty itself. So you all remember how we started into this year. It was a calm weekend, pretty calm, and then all of a sudden the US decided to conduct a military operation in Venezuela, capturing that, I would say almost democratically elected president in Venezuela, and bringing him home to the US. So quite an intense start into a new year. Later on, of course, what is close towards here is Greenland as well, where also the sovereignty of Greenland has been challenged. Later on, of course, what happened in the Middle East and so forth. So the key message here is that sovereignty is not really guaranteed. And what we see now is a shift of a reality from sovereignty, from a legal concept towards a power reality, where the bigger nations, the ones with the bigger guns, are more or less just getting whatever they think belongs to them. And again, also here, the US, of course, as a prime example of exactly this behavior. And if we just go back like the last 6 months, we see quite a lot of those kind of events. So if states are not entirely sovereign, how can we be sovereign as private individuals and as citizens? That's the key message here. And well, the answer is, of course, also not too far away. So we're not. We are as long sovereign as long as we are, and sometimes something changes, and the history is unfortunately full of examples where exactly this happened. We can go back a little bit further into the history. In the early 30s in the US, where, for example, gold was all of a sudden banned from private households. So everybody that actually was possessing gold in their private households all of a sudden faced sentences, prison sentences, but also extremely high fines that are now 6 digits in today's terms. So all of a sudden, something that was completely normal is now banned. Then we have more recent examples, of course, the Latin American debt crisis, where all of a sudden you couldn't access your bank account anymore. Europe as well, we were also in a financial crisis not too long ago. You have a lot of money on your bank account, but from one day to another, you cannot access it anymore. You have a withdrawal limit on your ATM, for example. You have limits of what you can transfer abroad. You have all of a sudden crazy FX rates, and you basically don't have any opportunities or possibilities to leave the systems unless, of course, you play along and, of course, take the hit. So that's a little bit the message here. So also private wealth is not immune against those kind of state interventions. And that brings me to the next chapter, the stress test of a system. So if we look at the government that already has some sort of a history of not always taking care of sovereignty, especially of other nations, but also not of private individuals, is on the other side also extremely leveraged. So we live in a fiat universe, of course, as it's known to all of you, but the state is not necessarily de-risking the current position. They're doing the opposite. They're trying to roll over debt more or less towards future generations, away from sovereign balance sheets, more towards private households. So current debt levels are at record highs. So the last like 10 years, global debt increased by around 50%, which is a pretty crazy number. On the other side, we have most advanced economies that already have exceeded the 100% debt ratio compared to the GDP, which is also probably not necessarily going in a very sustainable direction. So the state is not de-risking, the problem is just moved over or shifted over onto future generations. At the same time, we have a pretty interesting demographic situation. So because of fertility numbers and reproduction and so forth, replacement of people that have been in the working class, numbers are being reduced. So at the moment, we have 3 working class people that are paying for 1 retired person. By the year 2050, the number is reduced to 2. So that will have a huge impact, of course, on everybody that is working, trying to finance through everybody that is not working. Longevity is, of course, playing into this effect as well. If we take another interesting metric, that's, of course, inflation. So it's not just the social system that is being challenged by just the pure demographics of it, it's also actually saving as a concept. So if we blend in inflation rates, and if we take a 20-year-old person that is now for the next like 45 years trying to put some money on the side and building up a saving, if we blend in 2% inflation rate, that purchasing power is eroded away by 60%. If we do it with 4%, we're already above 80%. So that's also pretty crazy, because when I went to high school back in the days, and the big goal or strategy was put some savings on the side and you will have like a great retirement whenever you retire. But those concepts are heavily challenged by the pure demographics. And now let's blend in a topic that is also omnipresent, which is AI. AI, of course, has the opportunity, but also the characteristics of massively disrupting basically everything that we're in. So AI is already now disrupting a lot of the working class, especially white-collar jobs that are being eroded away. So, and there is a lot, of course, of different studies saying that AI will also create a lot of jobs, and it's actually not that bad. But to every single entrepreneur that I'm talking to, I don't really see a lot of people integrating AI into their companies in order to then hire more people at the end. You might hire more people temporarily, some experts, but always with the goal actually to become much more efficient and not hire more people. So also this will have a massive impact on society. So it's not just the over-leveraged kind of government, it's a demographic situation, but it's also AI that is coming in with like a high-speed train, and it's very difficult to capture in what direction that goes. And of course, also that is extremely disrupting, but also challenging. So that brings me to the next chapter of the collapse of trust. So if we combine all those different elements together, trust is, of course, suffering. So we live in a fiat world, as I mentioned at the beginning, and fiat is based on trust, primarily trust. Trust into centralized systems, into governments, into banks, central banks, and so forth. And at the same time, looking at the previous numbers, we have record high debt levels, and we have record low productivity levels, which per definition is not very sustainable kind of setup. And that bundled together, of course, with the high debt ratios that we have seen before is challenging. And usually whenever those aspects or those parameters play together, historically seen, the system resets itself, either through inflation, financial repression, through default, or, and that's why I'm actually not that negative, through innovation. So innovation of something new because people need an alternative. If I'm now putting my life savings on the side and I hope that I will have a great life whenever I retire, it's probably not going to work out. And that's a brutal reality that not many people are thinking of. But at the end of the day, it's about your money, your own destiny, and your future. So that's why I'm actually since 13 years advocating for a new monetary architecture, because people should get the sovereignty, at least when it's about money, back to themselves. And thanks to technology nowadays, we actually have all the opportunities and the potentials and the possible means in order to do exactly that. So it doesn't really matter if you're like an asset manager or a family office or a private individual or even like a sovereign fund or a government. you, at the end of the day, when it's about money, you want to control money yourself. You don't want to depend on somebody else that is gatekeeping yourself, that is trying to dictate when you're able to access your funds and when you can transfer them. So that's a big problem, and thanks to the technology we're having nowadays, that I don't need to explain you all, that are based on decentralization, that are based on programmability, on trustless systems. We have all the possibilities in order to actually enable that. So that's a good part about it, and that's also what brings us to the final chapter, which is the choice. So as I mentioned, today's world is extremely unsustainable, in my point of view, because we're not necessarily creating a lot of wealth for future generations, but primarily obligations. So debt is not really honored, and purchasing power also not, because whenever a government is actually trying to increase the balance sheet and generate more debt, it's easier to roll it over than to pay it back, because pay it back means you need to cut costs somewhere or actually do manage your household in a better way. So that's why it's not very sustainable, and that's the current status quo. On the other side, we have this beautiful potential technology, which is decentralized technology, and of course Bitcoin as the symbol of it, which in my point of view is the only sound money in a broken system, because it's completely decentralized, it's completely transparent, and of course it has its issues as well, quantum and all of that, and it needs to overcome them. But as a concept, as a new monetary architecture, it definitely gives us a choice. And the question at the end of the day is just, do we understand the importance and the magnitude of those decisions? Because at the end of the day, it's all about our own destiny and our own money, or can we still afford to ignore it? That's basically it. So if you like one or the other of the thoughts, please feel free to reach out to us. If you have like similar ideas or concept that you would like to discuss, that's basically what we're doing. We're here to protect and safeguard our clients' assets and also to help them compound them into the future. Thank you very much for your attention and have a lovely day. Thanks. Thank you.
Thank you. Thank you so much. Yeah, it's our headsets that are interfering. Perfect. So for the next keynote, for the next 15 minutes, we are hearing from Nina Louise Siedler from Siedler Legal. And Nina advises a lot of crypto companies, financial institutions. I'll let you do a more in-depth presentation, but especially on MiCA, on regulation. And for this particular keynote, she will help us explore the more darker side of Web3, of market abuse.
Yes, thank you very much. But prior into delving this, I actually want to quickly wear the hat of being on the board of the Bundesblock, that is the German Blockchain Association, and would like to thank the Nordic Blockchain Association for their collaboration. We are actually aiming to work closer together when it comes to educating and upskilling decision makers in the policy field. Now we've got the MiCA 2 consultation being kicked off, and I think it's very important that the regional or national associations work closer together. So we are also collaborating with Ardent, the French association, and Alastria, the Spanish one. So we look very much forward to welcoming especially Magnus also on the Berlin Blockchain Weekend, doing some stuff together there. Who we are, we had been formed in 2017. We have more than 130 members and experts in our group, and basically as the Nordic Blockchain Association as well. We try to form a unified voice and stand up for better regulation and a satisfying taxation and the adoption in that space. Having said that, I want to turn to the topic that had been on the agenda, and now I'm, taking off the hat of the Bundesblock, and any opinion and statement made from now on is my personal one. And market abuse, that's, as announced, maybe a little bit darker topic, and it ties into the question of trust that had been mentioned previously. So where are we actually coming from? I think everybody is aware, the ICO wave in 2017 and 18 brought up a lot of scams and a lot of, I'd like to say, unhealthy market behavior with, early investors buying into the tokens for as low as 99%. And then when it became in the public market, basically dumping their tokens, or employees within exchanges knowing that something is coming up, actually trading in their own favor. So while I'm not a fan of the European regulation MiCA as a whole, because I believe that blockchain is not only financial industry-based, but has also a lot of use cases in the true economy. I was always a fan of the idea that we must extend the market abuse rules to the crypto space to clean up this mess. And that is what actually happened. So now we have a regulation that extends the market abuse rules to the MiCA, not to the full extent, but at least partially. So first of all, what is this touching upon? It's touching upon the inside information. So that is any type of information of precise nature. So it cannot be just a vague through the grapevine topic, but it must be an information that is precise, that is relating to issuers, offerors, or person filing for admitting to trading or to a crypto asset itself, right? So it's either the issuer side or the crypto asset itself that must be concerned, and it must be something that is not yet public. And we had actually yesterday afternoon on an expert roundtable a lengthy discussion what that actually means in the crypto space. Because you can imagine that there is some information available on chain, but the mass investors out there, they do not really read the chain as such. So it's kind of hidden for them. And is an information that is already, noticeable for people with sufficient knowledge on chain, is that already public or isn't it? So ultimately, I can already reveal prior to the report that we will be publishing about that roundtable that the main opinion was that as soon as something is recognizable, it is public, right? So the opinion is that such information is out. Simply because you don't do your homework, right? That doesn't mean that you're still protected by these rules. Yeah, and then inside information is only that information that, if made public, will most likely have a significant effect on the crypto asset price. That is something that I notice is not very much known in the space. It's not only the issuers and the crypto asset service providers that are subject to those rules, but it's basically anyone who has an information and knows or ought to know that it is inside information as previously discussed, right? So even if you look somebody over the shoulder and get some information there and you think, oh, wow, that's interesting, that will move the price, you're caught by those rules. And I think that is something that even specifically Layer 1 foundations miss sometimes when they claim, well, we are not an issuer, so that's not concerning us. Yes, it does. And it does also concern all the self-employed software coders that they might involve in producing a major update of the protocol or alike. So that is actually pretty wide. And that's why I put in this slide to say, well, there are a lot of situations where you think, well, that's quite harmless, right? That's not the scam of the 17th and 18th, but yes, you're still captured by those rules. So what are actually the consequences when you have such inside knowledge, something that is not public but that may move the market? For everyone having that knowledge, you must stop dealing that asset that is concerned, right? You're not supposed to leverage that knowledge to your own favor. And that does not only mean you're not supposed to buy and sell, but also, don't amend any orders that are already placed. Don't modify or withdraw any bids, and also do not, without permission, disclose that information, right? So you're basically expected to sit still and wait until that information becomes public. And then you can start trading again. For the issuers and CASPs, the obligations are more far-reaching, so they are actually obliged to, as soon as possible, publish that information and not to keep them to themselves. And yeah, there are a couple of further details. So it's prohibited to combine that with any marketing speech. So it must be clearly visible as a disclosure of inside information. You might know the term ad hoc message, right? So that is what term is used in the typical stock market for this. You need to leave it on your own website for at least 5 years. And you need to think about where else you need to disseminate that information so that it actually reaches the public concerned, and that is the investors that typically invest into that asset. So you must make sure that they have a chance to notice. Yeah, there are a couple of rules for the website disclosure which need to be observed. I don't really want to go into that detail too much, but what I would like to point any CASP or issuer to, if we have in the audience, is that you need to have a dedicated section on your website. And soon, the supervisory authorities will start to screen your website and see if you have actually that dedicated sub-site on your website. So even if you don't have any inside information to disclose right now, make sure you have that sub-site in place. Even if it's empty, and it will not be full empty because there is another obligation, and that is this one. You need to enable people to opt in to get notified when you put anything on that sub-site, right? So that function needs to be implemented right now, even if there is no inside message that you want to communicate today. Yeah, then there are more things to think about when it comes to disseminating such information. I think we are all agreeing that the typical crypto investor does not really read Bloomberg or Reuters. So what do they read? Well, they look in their Telegram channels, in their Discord channels, on X, on LinkedIn, social media. But they not necessarily notice, regular, traditional media. And therefore, in order to reach those investors, you also should put it out into social media. That is a little bit more complicated, right, than putting it simply or sending it over to Reuters or Bloomberg. And it also comes with certain obligations. You always need to link the full text and the website, sub-site where you published this on. And again, no mingling with advertiser material. All right, yeah, that is the Darty series that Mariana de la Rocha and I kicked off like 2.5 years ago, and where we discussed yesterday also inside trading topics. It had been our 30th of these round tables, and we always strive, we always do family pictures, and we always strive to discuss topics that are not really 100% clear to the compliance and legal people out there, and to agree on what we like to call the industry best practice opinion that is then published in a report. So the one about the inside information and market abuse topics of yesterday will be published maybe in 2 weeks' time. And we love to take topics forward, and we actually did it with a relevant topic in that context, and that has been something that had been brought up multiple times by exchanges before, that they actually don't really know how to disseminate properly. and how to keep evidence. How do you keep evidence of what you published on social media? I mean, Elon Musk might not like you tomorrow any longer and simply delete your account. So how are you supposed to prove what exactly did you post when in like 2 or 3 years' time? And for that, we are building this Damien platform that will then capture everything that you have posted. And we thought we made it a little bit crypto native. So we will hash it and bring it on multiple chains so that you can have evidence and a timestamping of everything that you have published independent of what happens to the social media that you used back in time. All right. And having said that, whoops. The last slide is gone, doesn't matter. So I stay on that slide. I would like to ask you if you have any questions, and thank you for your listening to me. Thanks. Any question in the inside dealing market abuse area? Had that been all 100% clear before? All right. Then I leave it with that. And thank you very much. And hand over to the next announcement.
Amazing. You can just bring here, then it doesn't interfere. Let's see. Let's give it a hand. We switch us back to the. Let's see. Perfect. Because, let's see, I think Hannah's getting mic'd up and run it as well. Let's see, yes. Absolutely. Perfect. Will you check to see, check with Hannah? She should be ready soon. Okay, so while we're waiting, let me just see if I can jump. Do we have anything? Nope. Final one for now. Let's see. I can see Hannah here. Perfect. 1 minute. I'm running this here. Amazing. Let's see. So for the final fireside, that's a tongue twister, of today, we are very excited to welcome Hannah. She is partner at Stratum 3 Ventures, and she will be having a discussion with Ronit Goose, who is leading future of finance at Citibank. That is their new blockchain and Web3 digital assets initiative. He will tell you much more about it. And they will have a discussion on the future of finance, everything from experimentation and especially institutional adoption, with Ronit being from Citibank. So let's see, we have Hannah here. Amazing. Perfect.
Sorry, but the legal lady emptied the room.
Sure.
She talked about market abuse, and then everyone left, right?
Let's see. We'll do a herd. We'll do a herd and
Anyway,
see if we have a few more coming in. Let us see.
For the troopers left in the room, I think you're in for a ride, because I've known Ronit for years. So this it's always interesting to have him on stage.
Yeah.
Yeah.
Absolutely. It's been a wild year for institutional adoption in the Nordics.
Yeah. And actually, even wilder is that Ronit and I did the training program in New York together in 1998 for Salomon Smith Barney, which then became part of Citigroup, right? So, yeah, very much coming from the TradFi, but I think it's just amazing the fact that we both done a bit of a journey in the sector, and with Ronit now being the global head of Future Finance Institute for Citigroup. So, as he's having a drink,
yes,
I just cannot wait to ask him. Obviously, well, the next question is actually, I would like to hear you talk a bit about the fact that, you know, you started as a bank analyst, right? And you were actually covering the Nordic banks. So you know this region quite well. And from that perspective, because you were here on Friday and you came back and now you've been here a few days, sort of seeing the big banks and you met with the Riksbank and
Yep.
etc. So please just give us your thoughts on what you're hearing and seeing.
Sure. Well, thanks for inviting me, Hannah, to join you on stage. The Nordic fintech, digital assets, more broadly tech and finance world has changed a lot in the 20, 30 years I've been coming to the region. In the late 90s, early 2000s, through the 2000s, you could really argue that the Nordics were a poster child for the rest of Europe, maybe even the world. People talk about the AI bubble now. We used to talk about the internet bubble and the dot-com bubble back then in 98, 99. And what was happening in the region was truly groundbreaking for about 10, 15 years, up to about maybe mid-2010s. Now when I look around the world with a global view, when I look around all over the world, the most interesting developments in technology are happening for the last 10 years on the east coast of China. It's happening in Hangzhou, the home of Alibaba, or Shenzhen, the home of Tencent. It's very much, particularly on hardware, happening in China. When it comes to software or intangibles, the Bay Area is undefeated, and New York. And so I think about like digital assets or emerging technologies. Those are some of the hotspots for me. Unfortunately, my home for most of my life, London, I don't consider to be in that maybe top 3, 4, 5 centers anymore. It used to be when we did associate training all those years ago. And Stockholm punches above its weight still. I still think Stockholm, on many metrics, punches above its weight. But on digital assets, it's harder to make a case that Stockholm is one of the digital asset centers. It is a center, but is it like a leading center? Whereas 20 years ago, you'd have argued Stockholm should be a leading center because 20 years ago, Stockholm was like almost the undisputed tech capital of Europe. And now you look at it and you go, I don't mean melancholic, but it's a little bit of melancholia. I know this is the last panel of today, so I should be like energizing you so you can go back into the sunshine and be enthusiastic. But it's a question I asked at breakfast today. I was lucky enough to, with my city colleagues, host a breakfast with the C-suite of many of the largest financial institutions in Sweden and the Nordic area. And I threw it out. I said, you guys were like the center, way above your kind of your weight category when it came to what happened. I have answers, I have thoughts, but I don't. What do you think, Hannah? What happened?
No, but I think you're right. Obviously, I was fortunate to spend 10 years in Hong Kong as well, and came back to Sweden in 2016. So my journey into this space was very much because I found fintech being sort of a nice application on top of legacy technology, and then got intrigued by the blockchain. And I think many in this room is completely converted and see that, right? So, but it's just interesting to hear from your perspective. We put somewhat the title on this as institutional adoption. And I think throughout the day, there's been a lot of talk on the kind of supply side. There's technology there. There's been talks about regulation, etc. But can you please touch upon a bit the demand side? And are we seeing real institutional adoption?
Yeah. So right now, when you look at blockchain, whether you look at, say, stablecoins, or tokenized assets, or crypto-native assets, if you look at each of these categories, the percentage of institutional activity, the actual percentage, is still relatively low. But the expected growth is very institutional. So the question is, are we really at a takeoff point, or is it another hype cycle? All new ventures, all new technologies, all new things need a story. Blockchain is no different. Everything needs a story. You can't just say, oh, I've got this really interesting thing called a railway or a steam engine or electricity or internet, you need a much bigger story to sell that. The story of the steam engine was we transformed agriculture and industry. We transformed urbanization, first in England and then around the world. You could even say the steam engine to the factory led to basically the modern map as we, I don't know if any of you, we just finished the English football season. England has like 2 or 3 still world-beating exports, and one of them is the English Premier League, right? So last season just ended this weekend, and you look at all the top clubs outside London in the English Premier League, where are they? They're all in cities that became really big in the 1800s during industrialization. Without the train and the steam engine, none of these cities would have grown. So in a way, the whole modern... So the story of the steam engine isn't just... And so blockchain needs a story. Crypto needs a story. And the story right now we're all hanging on to, in a way, is we're hanging on to it. The institutions are coming. I hope the institutions are coming, and I'll explain why I think they are in a second. Because if they're not coming, my crypto friends have all invested a lot of money in expensive suits. Because I see them at conferences, not necessarily here, but Paris Blockchain Week, and I'm back in Paris for Proof of Talk next week. My crypto native friends, the CEOs now wear more expensive suits than I do. So why? Because they're selling to institutions. Now, why do I think this could be real? 3 things are happening that make it, I think, not 100% likely, but let's say 70, 80% likely that the institutions are really coming. Number 1, and I know regulation sounds boring, but the regulatory and legal frameworks in Europe, in the EU, and in the US are becoming much clearer. Now, no pun intended, clarity, we don't have any clarity on if clarity will pass or not. The Clarity Act is the US legislative package around tokenization and digital assets. It's still, I was chatting to a colleague of mine in New York, and it's still yesterday evening, actually, and then another friend who's in another institution in the US, not a bank, and she was like, actually they own a bank, they're a broker-dealer. She was like, I don't think clarity will pass. Someone else was saying to me, I think clarity will pass. Now, the point is, it almost doesn't matter if clarity passes or not through Congress in Q3, because the regulatory agencies in the US are all saying, this is kosher, you can do it. So the regulatory agencies are giving us the cover and the comfort we need to do tokenization. Now, this is really, really important because 2 years ago, that would not have existed. Because I've had conversations with corporate treasurers and CFOs in the last 2 days in Stockholm who've saying, we've been talking about tokenization, like just now with a large international company of Swedish origin. They said, we talked about tokenization for 10 years at conferences. What's new? And I said, what's new is that it's now legal for a bank. That's pretty important. Number 2, what's new is institutional structures are maturing. When new things happen, new things start as what? New things start, this is like, if you look at through the history of change, and particularly innovation, new things either start as a toy, or people call it a toy. A lot of banker friends of mine who are older than me looked at Revolut 10 years ago and said, it's a toy. And I'm like, oh, okay, you know more about banking. This is 10, 15, 12 years ago. Now they're all retired and they're active power users of Revolut. You said it was a toy 12 years ago. Okay, anyway. So everything that's new to, it's like when the iPhone was launched, I think famously Steve Ballmer, when they said this is a toy, was there no keyboard? Even I said it because I was addicted to my BlackBerry, right? We all said it. If you were, so everything new looks like a toy or a crime. You know the Trevor Noah autobiography, Born a Crime? Because he came out of an interracial relationship, and back then in apartheid South Africa, that was, I think, I don't know the details, but I believe that was literally a crime. I joke with my wife sometimes, like, when we go to the US, oh my God, it wasn't that long ago that our marriage would have been a crime in half the states we're visiting. Because it was a crime, right? So when people say, and that's how innovation starts. My mum called me, oh, bless her, but she called me a few years ago, and said, your brother told me you're looking into crypto, you're investing in crypto. I saw a BBC program, it's just used by criminals. And I was like, don't worry, Mum. I'm like almost 50 years old. Actually, I'm over 50 now, but at the time, I was like, don't worry. I know what I'm doing. But she was worried because the BBC and other TV programs and newspapers would say crypto is used by criminals. I'm like, yeah, all new things. That's how digital payments began. Who do you think were the early users of, not crypto, just digital payments? Why did Visa, MasterCard, and the banks 20 years ago say we don't want to do online payments? Because, oh, bad guys will use it. That opened the massive window for Sebastian and Klarna to come through, right? So everything is, in innovation, is born a crime or a toy, and large institutions go, ooh, toy, not enough money, crime, well, we can't touch that. Then institutions mature. The companies, the infrastructure matures, and you go, ooh, okay. It's a bit like when I was a teenager, I had long hair, and I voted for the Green Party. I'm not an ecologist anymore, but I'm a capitalist. Those things can be combined. But
they can be
combined. I'm sure you got a fund on exactly that, right? But things grow. I cut my hair, put a suit on, and went and joined the bank. I mean, things mature. And that's exactly what's happening to crypto. So the second thing. So the first thing is regulatory change. The second thing is institutional maturation, and the third one is just old-fashioned capitalism. There's money to be made. Our clients are telling us we want to do tokenized products. And it's legal, and the institutions are mature, so obviously the banks are looking at this going, okay, and these are some of our biggest clients, right? Not just of Citi, but of the existing banking, off Wall Street, let's say. The biggest clients of Wall Street are saying, why do you not have a token? And so that is also driving the growth of, and this is why I think, even though today, when I look at stablecoin volumes, institutions are still small, it's largely crypto-driven. When I look at tokenized assets, numbers vary. Stablecoins are about 320 billion. It's kind of flattish last few months. It's up a lot year on year, but it's kind of flattish. Tokenized assets, 35 billion. It's a rounding error. Citi moves every night 4 or 5 trillion. We move a quadrillion plus every year.
So with that, I mean, one of the arguments, one of many arguments that tokenization is good, and you know, because it cuts out the middle layers, right?
Yeah.
So you have atomic settlement, and it's not T+2, and capital can be much more efficient because it moves more quickly.
Yeah.
But in a way, Citi can do this by themselves, right? And offer that to a lot of their clients.
Yeah.
So then, with that, and also the fact that many of the chains are permissioned, it's far from the kind of decentralized world that many in the room perhaps are aiming for. So what's your...
the journey of blockchain from the original cypherpunk crypto roots of decentralization, burn down the banks, burn down the Fed, burn down DC, to where we are now. That journey, I called it institutional maturation, but if you're a cypherpunk or an original believer, it's melancholic, right? Just like I said, it's, this is not what you signed up for. If you still believe in the kind of, if I was still me, aged 18 or 19, wearing ethnic waistcoats with long hair, I'd look at me a bit fatter and wearing a jacket going, what happened? But... things happen, and this is blockchain as well. It's kind of things happen, and things, and the biggest, don't kill me when I come off stage, but I find it hilarious, my crypto native friends, when they go on about decentralization. Come on, guys. Come on. Bitcoin is decentralized, largely. Ethereum, there are so many chains where the founding teams own significant part of the liquidity. They control the token issuance. There's a lot of, by number of chains, not by value, because the value is still largely in Bitcoin and ETH, but by number of chains. Most of the chains, by number of chains, are dinos. decentralization in name only. They're dinos there. Give me a break, guys. Most of them are not. And that creates real issues as well. Because if we're going on a chain as a big institution, and there's one or two individuals controlling the chain who may or may not be regulated, may or may not live in, I don't know, ABC country, that creates a big issue for us. Whereas if we're using Ethereum or a permission chain, we feel more comfortable.
So just going a bit back to, so we can conclude that it's not going to be completely DeFi, decentralized.
No, and actually the reason institutions are interested is, let's face it, nothing to do with decentralized, sorry to say it, but it's a distribution channel.
Yeah, so
it's about getting a product to a client base that we are not necessarily, or our clients are not big in. Our clients are interested in using blockchain because their clients, say they're retail in the asset management industry, their clients are typically 50 to 70 years old. Or in retail brokerage, they're 50 to 75 years old. They want to target a digitally native client base who are trading 24/7, who are living 24/7, who are basically on Coinbase or Robinhood and agnostic to whether it's a US public equity, a US unlisted equity, a cryptocurrency, a commodity, etc. Those clients are going to become, those users are going to become bigger over the next 10 years as they get older, wealthier. Our clients want to target those people. So our clients, and so we're servicing our clients, the buy side and the broker dealers, because they see an opportunity to use tokenization effectively as a distribution channel to target a demographic that they're not very big in, either by age or it's a demographic more by segment. So they're blockchain native, like digital asset treasuries, or the treasury of not an established manufacturing company or an established technology company, but the treasury of a blockchain company. You go to the treasury of a blockchain company, a big one, many of these are listed now, and you go, do you want to invest in tokenized T-bills? They'd be like, absolutely. And they say it's a new business opportunity. And then this is often either us directly dealing with a client or us dealing with another, so our client is dealing with another client, right? So we may not be dealing directly with the Gen Z kids, but we're dealing with a financial institution in the US or in Europe. They have the Gen Z client.
That's great, because that's where I want
distribution.
to head. So distribution, exactly. So think about banks in the traditional way. You mentioned asset management. You have distribution through private banking, wealth management platforms, and retail clients, and then you have the treasury, and you have capital markets, etc. Right, and the investment bank. So where do you see because banks wouldn't do it if they couldn't
make money?
Make money.
Yeah, that's capitalism.
Exactly. So where do you, and that's coming back to the adoption, right? Because the demand side is there, and clearly the banks are kind of preparing themselves for the demand because it's a bit of a chicken and egg.
Yeah.
But in these various verticals, like if you're a startup or if you're new into this, where would you go? Like where is it happening on your end?
So when you look at the different parts of the bank that have interest in tokenization or digital assets, you could say it's almost every part of the bank in one way or the other has an interest. So on the capital market side, on the capital market origination side, where we underwrite new issues of equity and debt, our new issue bankers get, these are thousands of, but they're getting incoming inquiries from a certain number of clients saying, hey, do you think we should have a tokenized version of our debt or our equity? So on the underwriting side, on the what we call capital market origination side, or banks call, there's interest from our clients. Then in the wealth or other areas, we have high net worth individuals saying, I have digital assets, can you custody it for me? These could be institutions or high net worth individuals saying, I could go to a digital asset native company and custody it, which is what I'm doing now, but you have all or a large part of my existing assets, the non-crypto or non-tokenized assets. I've got a relationship with you and another bank. why are you making me go to a digital asset native company? Now, some of these clients may just stay with their existing digital asset companies, but it's in, whether it's in, what is finance? Finance ultimately, for 4,000 or 5,000 years since written civilization started in Mesopotamia, or what we call Iraq today, there are 3 or 4 functions of finance, and that doesn't change. How we do it changes. How we do it, how we communicate, how we manage information, how we structure products, that all changes. But the ultimate basics of finance, I don't think changes. What is finance? At core, it's a safekeeping custody function. The temples of Babylon, you went and kept your precious assets there in the temple. That became these wonderful bank buildings with marble pillars, but kind of starts in the temples of Babylon. There's a custody safekeeping element. There's a payment element, which is moving value. And then there's an investing and credit element, which is you want to do something. You don't have the funds right now, but someone else does, and they've deposited with me or kept it with me. Or I can raise it from other people. That's the underwriting function. Those are the kind of 3 basics of finance. Hasn't changed. But how we do it changes dramatically. How we do banking changes dramatically. How banks, the structure of banks today looks completely different to 100 years ago, to 50 years ago, even 30 years ago. 30 years ago in Sweden, there used to be bank robberies. Like, who robs a bank now physically? Like, what would you find in a bank? I mean, I don't know what you'd rob, right? Yeah, bank robberies are online, right? If I was a bank robber, I'd be like cyber hacking my way into the Swedish banks. I'm sure people are trying, including very well-funded actors. But literally, when I first visited Stockholm, there was this gang that would go around Sweden ramming their trucks into ATMs. And that was quite successful for a while. Even now, if you set up a branch or a bank in Nigeria, you spend a shed load of money on 2 things that you'd never think about in Stockholm. Number 1, security, a big guy with a gun, probably. And number 2, a generator, because the power goes down in Lagos. How you do finance in Lagos is completely different to how you do it in Stockholm. But the underlying functions don't change. And that's what I think is like blockchain, crypto, tokenization will change every part of that, how you do finance. But the underlying functions don't change.
Excellent. We don't have that much time, but I would like to open up to questions. So anyone has any questions?
Or maybe you have answers.
Yeah.
Because people always say at this stage questions, but how about, do you have answers? Yeah. Do you have answers about why I'm melancholic about, how's Stockholm going to get its mojo back on? Or maybe you guys are going to help get Stockholm's mojo back. I see nodding in the front.
I think this lot is trying hard.
This lot's trying. I see nodding in the front.
Yeah. Yeah.
I feel like an Austin Powers theme song should come up now. Do-do-do-do-do.
I don't know if we have a mic or...
No, yeah. Or you can shout.
Yeah. I would love to hear a little bit about, if you can say something about collateral. So
collateral.
Loan creation, one of the most important things that banks do. First of all,
can digital assets be good collateral? That's one question. And another question, tokenization, big question. Don't expect that you can get precise answers, but do you imagine a future where, let's say, you could put a crude carrier basically on the blockchain as collateral? Like
sorry, a what on the blockchain?
Let's say a crude carrier.
Okay.
Real-world assets.
Right.
Could you make some sort of tokenization of it that can be moved around as collateral? Is that possible?
Yeah, it's possible, but listen, in 2023, I wrote a report, or my team wrote a report, and I put my name on it, but I wrote a report in 2023 saying that it was the consensus in 2023 that illiquid assets were the unlock for tokenization. Tokenization would be great for real estate funds or VC funds, because VC funds were gate-kept and you had to have lots of money to access it in most countries, or PE funds, and tokenization would bring these illiquid assets to a mass audience. And you could say a ship or a tanker or a Rembrandt or a Van Gogh painting is the same idea. The problem with that thesis has been that it's kind of hard to take something that's illiquid and very unique and put it on chain. And that's where I think we made a category mistake or an error. Today, I mean, I'm so boring and consensual, but we're about to publish a report this week on Friday, hopefully, soon, a thematic report where we're saying it's going to be illiquid. Sorry, it's not going to be illiquid assets, it's going to be liquid assets. We've already written about this in presentations, we've talked about it in conferences, and other people have already said it, so it's not groundbreaking that what we're saying is that it's becoming consensus that it's going to be liquid assets driving tokenization. And I think, for me, where I've changed my mind and got much more excited is what I was saying before about tokenization as distribution. If I can take something that's already attractive to lots of people and bring it to new people, it's an easy win, or an easier win than trying to put something complicated and illiquid on chain. It's already hard putting something on chain. So why not make some bit of this easy? NVIDIA, everyone's wanting to, whether you're in the US, whether you're in Jersey City, Johannesburg, or Jakarta, you have a view probably on NVIDIA, and you want to trade it. Why not put NVIDIA on chain? And NASDAQ and NYSE are doing that, and DTCC as well. So make it easy. It's a bit like, I'm not going to become uber fit and do a, triathlon tomorrow, but if I tell myself I'm going to do a triathlon, never going to happen. But if I tell myself, I can just walk around Stockholm when I visit rather than and I walk around all the cities I go to, at the end of the day, I've done 20,000 steps. It's doable. Same with tokenization. Take something that's doable.
Keep it simple.
Do something that's, like NVIDIA is, US treasuries, people want to own. It's liquid. It's not gonna, just put liquid stuff on chain.
Let's start there.
It's easy.
Yeah.
Then you can do tankers and Rembrandts and other stuff.
Yeah.
Hannah's VC fund or whatever.
Yeah. Should we see if we should do one more question?
Okay, if we have time.
Because my closing, I can, we can make a deal where I wrap it up in less than 60 seconds, and then we could do one more question, because I think you'd rather hear from these guys than from me. Anyone up for a final one?
No.
Come on, I need some exercise.
Well, then I just want to say,
I think a lady in the back was thinking about it.
Yeah,
I'm staring at her. Yeah, you're pointing at yourself. No, I thought you would know.
No, I think it was more me shutting up in 60 seconds.
Well, Ronit has not asked me to say this, but Ronit has actually written a book called Future Money.
Oh, yeah.
So if you have a mother or a grandmother or anyone that you are trying to explain this to and why it is important.
Or a father. Come on, Hannah, let's be equal opportunities. So gender biased.
Yeah.
She's not going to forgive me for that.
I highly recommend it because but you nicely walk through the history also and explaining.
Thank you. It's available on Amazon.com.
Yeah.
And hopefully a new edition next year. So look out for that.
Okay.
Yeah. Oh. Thank you for having me on stage.
Thank you. Thank you so much. Thank you, Ronit.
Thank you.
Thank you so much, guys. I will keep my promise, even though there are no more questions. I will wrap this because I know that you want to have conversations. You want to go out in the sun. Tomorrow, we have such a packed and exciting day for you. Some highlights from down here. We're having Ledger keynoting. We have a fireside with Bitwise and Low Tech, and then a stellar lineup of multiple panels. So I highly recommend popping by tomorrow. We start at 9 o'clock to give some time for the evening's activities. The after party is tomorrow, and that is really exciting too. Let me see. Tonight, we have our partner dinner for sponsors and speakers. My colleagues are working like crazy to get a few plans finalized. We're really hoping to have a few other evening events coming through. So if you follow Nordic Blockchain Association on LinkedIn, we will put out a post if and when we manage to get another drink and evening set up for you guys. But thank you so much. It's been such a pleasure, and look forward to seeing you tomorrow. I hope that was 60 seconds. Thanks, guys.